things stay status quo, then I think you have the opportunity to see the markets move higher.
Since around mid to late April, it's been the mega cap tech companies that have led.
Volatility could remain elevated, but it's not necessarily an environment where you want to sell all equities.
I would not be adding a lot of equity risk to this rally.
The broader market is really driven by growth in technology, and growth in technology is okay right now.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. With stocks edging higher for a fourth straight day, hopes of Fed rate cuts are growing alongside pessimism about the state of the U.S. economy and animosity bubbling over between President Donald Trump and former First Buddy Elon Musk, adding pressure to an already fraught budget process. Before we get to that fight, Annmarie very much back in the seat, which is a wonderful thing. I do want to start with this idea of an economy in the United States that does seem to be weakening. We got ADP coming in with the softest numbers going back 2 years. We also got a pretty weak ISM services number.
Right, the first contraction in ISM services since June of last year. So the question now everyone is having, is the soft data starting to hit the hard data? And of course, this is all ahead of tomorrow's very important jobs report. And then there's the debate. What does the Fed do with this? Is the Fed ready to potentially cut rates? That debate heating up, and no other than at the White House. It was that ADP report that we saw the president take to Truth Social saying the ADP numbers are out. Too late, Powell must now lower the rate. He's unbelievable. Europe has lowered 9 times. And he's boning him to try to do more.
And just to clarify, it has been 7 times that the ECB has cut rates, and it's going to be probably number 8 later today. It is notable, though, that we always talk about who cares about ADP, and then ADP comes out lower. And first of all, markets did care, but so too did the president, as this is sort of key to a lot of the question marks underlying some of the squabbles right now in Washington, D.C.
Right, and the squabbles are front and center because right now we are 29 days until their self-imposed deadline of July 4th to try to get the one big beautiful bill. And the fights are out there in the open. It's not just Elon Musk taking to Twitter saying, kill this bill. There's fights as well when it comes to SALT. What did we hear from Senate Majority Leader outside the White House yesterday after he met with the president? He said, really, there's no Republican senator that cares to keep a high SALT deductible cap. There are a number of fights amongst every single provision, and the math just doesn't make sense to get all the Republican senators on board with all the House Republicans.
There are House Republicans from New York, New Jersey, L.A. There are not necessarily Senate Republicans from New York, New Jersey, and L.A. Just to sort of underscore whether the budget process is really roiling markets or not. Yesterday, we saw the biggest rally in the 30-year yield going back since February, and part of this was on the heels of expectations that maybe growth was slowing. It just underscores this question about how much what we've seen in the bond markets really is tied to this increase, this expansion of the deficit.
And potentially the deficit will expand. If you look at what some senators are asking to be added into the bill, things like making business tax cuts permanent, that would expand the deficit. Although I would note, the Democrats, Senator Schumer, wanted the CBO to score the tariff impact. It actually helped the White House's case because it said, yes, this bill adds the deficit, but when you consider what current policy is on tariffs, it actually helps.
Yeah, they talked about keeping tariffs high for a prolonged period of time, bringing in, I believe, $2.8 trillion versus the $2.4 trillion increase in the budget deficit. We'll be talking about that coming up right now. Equity markets basically in a churn, marginally higher after yesterday, eking out some kind of gains at the end of the day after a tumultuous session. This isn't exactly a runaway rally, nonetheless, still in the green. What you can see in the bond space really did end up driving a little bit of this action yesterday, where the data was weak enough to include possibly more Fed rate cuts, but not so weak as to suggest some sort of recession. The 30-year yield yesterday dropped by 10 basis points in the United States, currently 4.86%, heading lower yet again with the 10-year also 4.35%. Coming up this hour, we'll be talking about that with Lori Calvasina of RBC, with the S&P 500 on the brink yet again of a bull market. Bloomberg's Tyler Kendall as Republican senators look to strike a deal on SALT, and Krishna Guha of Evercore as Trump renews his push, as Annmarie was just mentioning, for the Fed to cut. We begin this hour with stocks looking for a fourth straight day of gains. Lori Calvasina of RBC is among other strategists raising their S&P 500 year-end targets this week, writing, "Our new price target reflects our belief that the stock market is on a slightly better path than the one it was on in early April. We view the sentiment as the main risk to our call. Lori joins us now. Lori, before we get all bullish, and thank you so much for being here, this isn't exactly a bullish upgrade to your forecast. You still see declines for the full year.
Yeah, look, we came out at 57.30, and clients who know me know that I'm very kind of quantitative and nerdy with these targets, right? And we have 5 different models that we look at right now, and 57.30 is the median. The 2 more bullish ones are our cross-asset model, where bond yields have been on the move, so that one makes me a little queasy right now. But also sentiment, that could also get us more constructive, and we have different ways we're looking at that, but maybe 63, 6,400. That would really, in my mind, be the bull case. But the problem is sentiment is melting up so quickly. My model is rapidly exiting attractive territory. So I don't know where it's going to be in a couple of weeks. I don't want to bank too much on that. When I look at my 57.30, that's probably, my analysis that I'm most comfortable with right now, and that's our valuation and earnings modeling, where we're baking in 1.3% on GDP. We're baking in a few cuts from the Fed starting in September. We're baking in 10-year yields moving up, but then going down to 3.8%. And we've got a little bit of margin degradation in the back half of the year. We think that's all a pretty reasonable scenario to look at, and we've got inflation in the high 2s, not the mid 3s. So we think things are better than when we went to 55.50 back in early April. But I'll tell you, Lisa, after we got that China-U.S. de-escalation a few weeks back, I got a lot of questions. Well, why aren't you just putting on your January target? Why aren't you just going back to 6,600? And I just said, look, we're not back to where we were economically or in terms of the broader macro backdrop back then. And I thought that was an important point to emphasize.
And that's something that really underscores your concern about where sentiment is right now.
Yeah.
Let's talk about feelings. I was thinking about yesterday how feelings are so good that even when we get bad news, it is interpreted as good news because it infers some sort of greater degree of Fed rate cuts. Yesterday's ADP report, okay, you can put that aside for 1 second, even though it was the weakest going back 2 years. The ISM services data showed the first contraction, as Annmarie was mentioning, in almost a year. The new orders component falling to a 2-year low, and this was stagflationary, with prices increasing to the highest level going back to 2022. Were you surprised the market didn't respond more?
So, look, I think that we're getting into this sort of situation where, a couple weeks ago, people were like, well, look at the tax bill, look at deregulation. Those are things that are going to get us excited. And now you're starting to hear, well, maybe we're going to get some cuts for the Fed. And so I think that people are looking for those glimmers of optimism to hang on to. I'll tell you what surprised me about the ISM data, both the manufacturing and the services index, was if you had looked at the consumer confidence indexes, like the Michigan and the Conference Board that came out in recent weeks, we had been seeing some stabilization and inflection there. So the fact that we didn't get that in these, soft data starting to act a little bit better. Even a lot of the regional Fed surveys have been, we watched the employment and CapEx data points pretty closely, and a lot of those had kind of stabilized in recent weeks. And we just didn't get that on these 2 data points, and these actually do matter a great deal for business sentiment.
Didn't we see those surveys stabilize, though, because of sentiment, the détente between China and the United States? But actually, to your point, we can't go back to where January was because there was a détente, and now we still have a war of words, and we still don't have a phone call between the 2 leaders.
Right, and I would argue since we went from that 145 to 30, we haven't had another big step up in improvement, right? I don't know, you would know this better than me, right? But I don't know if this is really we've taken a few small steps back, or we're just kind of in a holding pattern, but we certainly haven't gotten any better. And the other thing we really wanted to emphasize with our upgrade, maybe it was kind of a bearish upgrade in here. I feel pretty neutral, to be honest. But the reality is we priced in that de-escalation in about 5 minutes on the day after it happened. And if we are going to get another big step up in terms of the expectation for the path we think the stock market is on, we need something else big to give us a jolt in terms of improving the macro outlook and getting that backdrop not just a little bit better, but a lot better. And I just don't see that coming right now. I need a little more proof.
Well, what's big? Like what?
I think, if we think about GDP, right? So our economists took their number after that de-escalation up from about 1% on the year to about 1.3%. And consensus is at like 1.4, and it's been falling. So I would at least want to see the consensus start to turn around on GDP and move pretty sharply towards that 2% number. If we were to suddenly, wave a magic wand and get back to 2% GDP forecasts, that's a very good environment for the stock market. So there we'd probably get more constructive.
What are you watching more today? Just to give a sense of your roadmap and how you rank some of the things that are sort of whipsawing markets, would it be the initial jobless claims, or more specifically the continuing claims, that gives you a sense of just what the jobs picture really is ahead of tomorrow's payrolls report? Or is it what's going on in Washington, D.C., whether it's Friedrich Merz coming to the White House or the ongoing negotiations over the budget that seem to be increasingly contentious?
Well, look, I think we have to look at all of them. I would say today, I am keeping a close eye on claims. I do feel like a lot of the disruption that we got in D.C. early on in the year, especially from some of the job cuts, we've been hearing clients asking, is that going to end up impacting the hard data? What's the timing around that? That's a really big debate that's out there that's kind of, not so much in the headlines. So I'm sort of interested to see if that story breaks down and if it comes back to the investor, kind of the forefront of the investor psyche. I do think that the tax bill, it was this thing, right, last fall, early this year, even just a few weeks ago, that a lot of people were trying to pin their optimistic hopes on. And, I agree that there's some really good stuff in that bill for the macro. But, we've replaced all that, sort of stimulus discussion with how do the Medicaid cuts end up impacting things? What about Section 899? What does that mean for foreign capital flows into the U.S.? And obviously the deficit, with the Moody's downgrade, that has come back into the forefront. So it's gone from being like this easy check the box, positive things for markets, to just a bit more complicated.
Yeah, and it seems like, Annmarie, when you have more than 1,000 pages, it's hard to just check the box when you have questions about what exactly all is in this bill.
Well, yeah, that's right. Some congressmen and women have actually not read the bill, even though they've taken votes on it, which pretty much is standard operating procedure for Washington, D.C. They do a ChatGPT version, I think, with their staff. But it's challenging right now because the numbers are just so thin. And this bill, arguably, is the only bill Speaker Johnson remains to be seen if he's able to get any tweaks, if it were to happen in the Senate, through his caucus. It is going to be very challenging because their senators want to sanitize this bill on every single front, and it was the only way he was able to get it across the finish line.
And I believe that you have the House Speaker coming on the show later this morning, where we'll be talking to him about this bill, and we will bring that to you. Lori Calvasina of RBC is sticking with us for the hour. Don't miss that conversation with House Speaker Mike Johnson coming up at 7:30 a.m. Eastern, where he will talk about the path ahead for this spending and cut bill. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with JoAnne. JoAnne.
Good morning, Lisa. President Donald Trump signed a travel ban targeting a dozen countries, including Afghanistan, Myanmar, and Chad. The measure also partially restricts entry from a host of other nations, including Cuba and Venezuela. It reinstates one of his most controversial policies from his first term. Trump says the move was necessary for national security. Meanwhile, shares of Wizz Air are plunging in London, trading falling by the most in 5 years. The discount airline reported earnings that missed estimates and didn't provide guidance, citing poor visibility. Wizz is among the airlines that have been forced to temporarily ground Airbus narrow-body jets because of repairs required on their engines. And Citigroup is cutting jobs. The bank says it will trim its technology employee workforce in China by about 3,500 as part of its global streamlining efforts. Citi is trying to simplify operations and lift profitability to compete more closely with its rivals. Its aim, set out last year, is to reduce jobs by 20,000 by the end of 2026. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, failure is not an option.
We are all in this together. This is a team effort, and everybody is going to be rowing in the same direction to get this across the finish line. Failure is not an option.
Bloomberg's Tyler Kendall joining us next. And coming up in the next hour, as we were just saying, Speaker Mike Johnson, the Speaker of the House, talking about the bill that they have currently in the Senate after passing through the House. This is Bloomberg. To eke out a fourth day of gains, just clawing back to that kind of bull market idea, which we were talking about yesterday. We were so close to it, and yet even with just some real meager gains, unable to reach it today. Trying again, new day, up 0.1% pretty much across the board for the S&P, NASDAQ, and Russell 2000 under surveillance this morning. Failure is not an option.
We are all in this together. This is a team effort, and everybody is going to be rowing in the same direction to get this across the finish line. Failure is not an option. I'm hopeful that at the end we'll have 51 votes in the Senate, and whenever the bill goes back to the House, they'll have the requisite number to put it on the president's desk.
Here's the latest. Republican senators saying they discussed ways to scale back the $40,000 SALT cap with President Trump. Bloomberg's Tyler Kendall joins us now. It sounded like kumbaya with respect to John Thune. It is anything but, based on the reporting that we're hearing, and frankly, some of the rhetoric we're hearing out of senators and even House Republicans as this process grinds on.
Yeah, hey, Lisa, there's definitely some really contentious issues here, and it's one big, beautiful bill, so there's a few different moving parts that we could pay attention to. But since you mentioned SALT, I did actually have the chance to ask Senate Majority Leader John Thune yesterday what a sweet spot for lifting that cap might be, and he said they are still working that out, which indicates to us that there are going to be some changes that end up making its way into this bill. In fact, I spoke to one House Republican aide who told me that the so-called SALT caucus is still waiting for Leader Thune's call, because $40,000 really was the breaking point for them in the House. They actually had wanted more. And now you have some senators like Senator Kevin Cramer, who came on Bloomberg Television earlier this week and said that number could drop down to $20,000 or $30,000. And it was interesting to hear Leader Thune at the White House yesterday basically say there's not a single Republican in the Senate who really cares about the SALT issue, but they do understand that this needs to pass the House when they kick the legislation back over to them. Now, of course, Lisa, a lot of other contentious issues here, but I would quickly also point out we're watching closely what happens to spending cuts. I spent a long time on Capitol Hill yesterday with Senator Ron Johnson of Wisconsin, perhaps one of the loudest fiscal hawks at the moment. He told me he's pushing for ending the expansion of Medicaid under the Affordable Care Act. Of course, this is going to raise questions about cuts to benefit programs. And Lisa, at the moment, Republicans are trying to thread the needle here on what's really a politically fraught issue.
There's so many challenges when it comes to this bill, Tyler, and trying to get Senate Republicans and House Republicans on the same page. And then they have this self-imposed July 4th deadline. How challenging is that deadline going to be, even now more so, that one of their own, a former government employee, Elon Musk, is saying, kill the bill?
Right, definitely, Annmarie. There is a lot that goes into what really is this ambitious deadline. And of course, we know that the firmer, the harder deadline is going to be that X date, since there is going to be a hike to the debt limit attached to this bill. But that on its own is already proven contention, since we know the likes of Senator Rand Paul, for example, won't vote for any legislation that does hike the debt ceiling. At the end of the day, there's going to be a lot of different issues that are going to have to come to some sort of compromise here. And we should say Republicans have pretty broad agreement about the core tenets of the bill when it comes to the tax cuts, for example. And they do want to get this done quickly. But when you have somebody like Elon Musk, who's really adding fuel to the fire for fiscal hawks at a moment when the CBO releases a new estimate showing that the House plan would add $2.4 trillion to the deficit over the next decade, that definitely complicates matters for the White House, which at the moment is going on the offensive, calling these senators up directly to try to get them on board with this bill.
Tyler, before you go, I just would love you to comment on how unusual it is for this spending package to be used in tandem with some of the trade negotiations as both sweeteners and potential hooks for trade partners, and that there are provisions in here designed for trade negotiations, let alone the actual budget.
Right, and you're talking about also what's been referred to as the so-called revenge tax, where we could see individuals and corporations alike actually face a higher tax rate if they're from countries that the U.S. deems has discriminatory tax practices. Think about the digital services taxes that this country, or this White House rather, likes to take aim at, such as those trading partners that are in the European Union. Another also interesting part of this, of course, is that other CBO analysis that Annmarie mentioned at the top of the program that actually would be in favor for some of these Republicans' arguments that there will be a large amount of tariffs used as creating revenue. But at the same time, we have to keep in mind that while the administration likes to talk about tariffs as a revenue raiser, they also talk about tariffs as a negotiating tactic, which means that there's so much uncertainty here, which could ultimately impact those end numbers that they could see coming into the government.
Tyler Kendall, thank you so much. Great work as always. I am curious about how important it is for markets right now to have a sense that these things are going to get wrapped by July 4th when it comes to the bill, and then July 9th when it it comes to some of these trade deals. Lori Calvasina of RBC still with us. From your perspective, is that crucial for markets?
I think there's a window of opportunity. And what I mean by that is we're going to kick off with a very important earnings season in mid-July, and that's really going to be the dominant focus from mid-July through early August. So if they want to sort of capture the market's attention, I think that's when they do it. After that, I think, they don't really have an opportunity. People are out late August, frankly, and then you get into the September and the fall time period. But I think if people really want to work this into their 2026 outlooks, and that's where I hear it coming up a lot with clients, is the stimulus that it could add to next year and make people just skip over the messiness of 2025. I do think if you want to really do that, you've got to bring it forward.
How challenging might earnings season be if these deals are not wrapped up, to Lisa's point, July 4th and July 9th?
It's interesting, Annmarie. In this last reporting season, companies did a whole lot of talking about tariffs, but not a lot of specifics. And there was a lot of stuff that was all over the place. And if I'm thinking about the industrial sector in particular, that's really at the center of this, it was, don't worry, we got this. We can manage through mitigation, adjust supply footprints, and pass on pricing. It was and we have a bunch of inventory. So I think what we're going to see, in this next reporting season, are those mitigation strategies working? The ones that were going to take longer to come on, how long are those going to take? And my guess is nothing has really been resolved enough to kind of unfreeze the business activity, kind of a freeze that had happened. So we'll obviously get a lot of questions on that, but I think it has the potential to, frankly, be a little bit disappointing, just given the confident tone that a lot of those industrial companies had.
We talk about business community needing a lot of clarity when it comes to trade and tariffs. How important is it when it comes to taxes?
I will say on the corporate side, just looking through earnings transcripts, I have found very few comments on tax policy if I think back over the past year. So I think tariffs are probably more important. I do think that, some of these issues are important for investors broadly. I do think, things like expanding the child tax credit, we always see that kind of stuff pop up in earnings calls after the fact. So I think it'll be meaningful, but I don't know if we'll necessarily see a lot of forward-looking commentary on it.
How do you put into perspective things like Procter & Gamble this morning announcing that it would slash about 7,000 jobs, highlighting some of the potential weaker consumer demand and tariffs, or Walmart coming out and saying that they're going to raise prices due to tariffs? And then yesterday, there was reporting saying that Walmart executives said, we don't aim to be a political figure. We are providing facts as they come. And they stood by, continuing to warn and be transparent about how they were really transmitting some of the costs of tariffs.
Look, I will say that companies across the board, particularly in the industrial kind of materials complex, if you go all the way back to last November, and remember, I'm a transcript junkie. I read these things all the time. I read conferences, I read earnings. People make fun of me for it now at this point. But going back to last fall, after the election, companies in multiple sectors were saying they would pass along pricing if it was needed, that they would try to do all these other things to avoid it, but when push came to shove, they would do it. And frankly, the industrial companies were a lot quicker to say they were going to pass along those prices. So I don't think these consumer companies that have been in the spotlight recently for saying this have said anything that wasn't said by other companies.
This does come, though, with what we saw in ISM services yesterday. That was really stagflationary. We really have to keep highlighting that. The prices paid component of this rose to the highest going back to 2022, even with weaker growth. And I just wonder at what point we can lean into that as a consequence, that there are going to be marginal price increases, and then it will be disinflationary on the longer term, but in the near term, really stagflationary.
No, I think that's fair. And look, I didn't answer your question before on the layoffs, but I've been noticing this as well. I'm looking at another headline, right now that's talking about job cuts in a completely different industry. And we do know that certain sectors have sounded less confident about their ability to manage this issue. I would say the consumer sector is one of those. And, I sort of think about this pricing discussion. If you don't pass it on through price, you've got to maintain your margin somehow. That is what companies are supposed to do. So there will be cost cuts in other areas to offset.
Lori Calvasina is sticking with us, and I have to say, Annmarie, Transcript Junkie would be a great name of a band. I can imagine it being really hardcore at high school.
She's doing God's work over here, but it's better Lori than us. Yeah. We don't have time for that.
It's actually really important right now because that actually gives you some sort of indication, and that's what the Beige Book essentially is.
Well, I think also it's interesting that Lori's seeing tariffs and trade consistently come up, but not so much the tax and spending bill.
Yeah, in part because of what you've been talking about, which is it's basically a continuation
of current policies.
Yeah. So it's not as much of an upside as a continuation of the status quo. Coming up, we're going to be speaking with Krishna Guha of Evercore as President Trump renews his push for a Fed rate cut on the heels of the ADP report yesterday. This is Bloomberg Surveillance. Trying to eke out a fourth straight day of gains in U.S. equities as they are about 3% away from all-time highs, really close to a bull market, which is a 20% gain since the low that was reached just on April 8th. My gosh, it has been such a huge, tumultuous ride. Right now, the Russell 2000 seeing the outperformance up 0.2%, 3 hours away from the cash open. Here are your morning movers with JoAnne. Yahaira.
Hi, Lisa. We start with the stock in the tech space, and that is MongoDB, absolutely soaring up 16%, a big move in a high-price stock. MongoDB, of course, provides software, database software to businesses, and it absolutely crushed its latest earnings. Hear this. It reported a profit of $1 per share, way above the 66 cents that analysts were expecting. It also raised its full-year revenue forecast and boosted its share buyback program. So MongoDB firing on all cylinders. Next up, we have Five Below, which is actually up 5%, funnily enough. The discount chain, of course, beat expectations last quarter and said that sales are running strong. The new CEO says the focus on product value and customer experience are paying off, with same-store sales rising up more than 7%, reeling in those kids with allowances, as you said yesterday, Lisa. Meanwhile, here's what they had to say on tariffs. They are expecting a profit squeeze in the second half, but they are trying to blunt the impact by cutting back on sourcing from China and working with vendors. And last up, we have PVH, and this is the company behind Calvin Klein and Tommy Hilfiger. Shares are down more than 8% here after it cut its full-year profit outlook, citing a $65 million hit from tariffs, because these apparel companies rely heavily on imports, especially from Asia. So that overshadowing what were otherwise strong results for the company. Lisa?
Thank you so much, Yahaira. And I will just say with Five Below, I don't think that some of the clientele are as price sensitive. Maybe their parents are, but not the clientele when it comes to buying gummy bears and the such. On our radar this morning, Tesla CEO Elon Musk is trying to block President Trump's tax bill after failing to convince Republicans to preserve EV tax credits. Musk posting on X, urging Americans to contact their lawmakers to, quote, kill the legislation, warning that, quote, bankrupting America is not okay, in a real war of words, an escalation between Elon Musk and President Trump.
Right, and we'll be speaking to Speaker Johnson in an hour. And he said yesterday that he called Elon Musk. He didn't pick up his call. He was waiting for him to call him back. So we'll find out on whether or not Mr. Musk actually called the speaker back. The question here for Elon Musk is this really about the deficit, or is it the fact that the House bill pretty much sunsets the green tax incentives from the Biden-era Inflation Reduction Act that obviously is helpful to Tesla? And I think that's a real question right now. And you're going to see potentially more animosity between Elon Musk and this White House. And the president, according to the speaker, this was a 180 for him.
Yeah, and this is a reason why a lot of people are looking to a question of how much this actually does matter and how much this does throw a wrench in the works. The EV price war, in the meantime, is heating up both in China and around the world. But in China, sources telling us here at Bloomberg, Beijing told EV makers, including BYD, to, quote, self-regulate and to not offer unreasonable price cuts. And Annmarie, this really highlights how there is a concern about cutting too much and about leaving themselves in a place where they don't have that profitability that's kind of key to continue to innovate.
Absolutely. This is unsustainable, it seems like, from the CCP, what they're telling their companies. You cannot just have this complete race to the bottom and then basically maybe companies in China could then become bankrupt. What I thought was so interesting about our story is that it highlighted these media outlets that are controlled by the Communist Party in recent days, calling automakers to stop discounting and restore order to the industry. Otherwise, this could lead to low price, low quality products that could damage the reputation and brand of, quote, made in China. And something that BYD has been trying to change, that stigma, made in China, is actually great and sexy. And this car looks like a Tesla.
Right. They don't want to end up just being the cheaper toy. And that's one thing that people keep talking about. How do you get the sort of brand superiority at the same time as having value? But it really highlights, Lori, and I'd love your thoughts on this, how much the auto sector has been just front and center when it comes to government intervention around the world, why it has become become the national champion, and how much that makes it really difficult to use this as an investable sector when it's used as a pawn in a lot of the international stories that we keep hearing about.
I think that's a fair point. And, it's a fairly tiny, outside of certain names, fairly tiny market cap, in sort of my world. I think that it's interesting. We ran a study a while back looking at different industries and their correlation with political polling data. And this is one of the ones that topped the list, which I think just, sort of highlights the extent to which it's become a political football. And I know whenever I talk to my analyst, he is always on top of every single bit of tariff news. A lot of it being faded, to be honest. But it is, it is just getting to be so tactical at this point.
Yeah, which is a reason why I think a lot of people, unless they want to get in on the in and out, are sitting on the sidelines. Fed Governor Michelle Bowman, has been confirmed by the U.S. Senate to serve as the central bank's vice chair for supervision. Bowman is expected to shift to lighter regulation than her predecessor. And this, to me, Annmarie, just quickly here, highlights how much we haven't even talked about the deregulatory push going on in Washington, D.C.
Right, and this is someone that's going to want to see that, a friendly relationship with the bank industry than her predecessor, Michael Barr, things like bank oversight, the stress test. I also think the direction of travel could be seen up close and personal if you walk into her office. We have a great profile of her from our colleagues today. And sitting atop her filing cabinet is a Make Community Banks Great Again hat.
I love it. All right. Well, this might also be part of what won her over in the eyes of President Trump, who did not win President Trump over. President Trump slamming Fed Chair Jay Powell once again, saying, quote, "Too late, Powell must lower interest rates after weak ADP data." Krishna Guha of Evercore writing, "It would take a large and rapid increase in unemployment driven by increasing layoffs to cut in July. It is easy for the Fed to justify remaining in a wait-and-see mode." Krishna joins us now. Trisha, thank you so much for being with us. A lot of people agree with you. At the same time, a September rate cut is pretty much baked in. Does that seem appropriate to you based on the economic data that has been weakening over the past couple of days?
Look, I have a base case of a September cut, but I don't think it's anything close to a slam dunk. I think right now the question is, does the labor market weaken enough over the next several months for the Fed to judge that it makes sense to lean against that weakening with a cut in September? I think to get that, you need unemployment moving up to something like 4.5% by September. I think it's a close call, to be honest.
And this is the reason why I think a lot of people are looking at whether it is just going to be one print, whether it's going to be a collection of prints. Something that caught my eye yesterday, we all are so data dependent, and yet this Bureau of Labor Statistics put out an addendum talking about how they collected fewer data points in the April CPI survey because of a lack of staff. And there's been this speculation about the accuracy of some of these surveys as employment has gone down and, frankly, as responses have gone down. How much credence do you give to some of the data that we get? Do you think that it still has the same integrity?
So in order to make good judgments, you have to have good data. It's as simple as that. Now, I still think that the U.S. government official statistics, BEA, BLS, are still the gold standard, but we have to be careful because, as you say, some response rates have been coming down, and now we're starting to worry about staffing cutbacks and other funding cutbacks, potentially weakening the quality of these data series going forward. So in any moment in time, you want to look at the holistic picture of the data and all the private sector data, including very much unemployment, so challenger layoffs, Indeed, job postings, and so on, as a cross-check against the official data and sometimes getting ahead of the official data. But I'll tell you, having seen, for instance, how problematic it has become in the UK, where some of their core official government labor data just hasn't been reliable for some time, it can be very, very damaging.
And that's a much smaller economy. So if you're not 100% trusting the data, you don't have policy uncertainty in Washington, D.C., what's your North Star these days?
Well, I think we know from first principles that tariffs are going to slow growth and push up prices, right? What we're trying to understand is the relative balance of those effects. I think that we're going to learn a fair amount over the next several months on both of these counts. But my hunch is that we'll learn more on the labor side than we will about what really matters on inflation, which is not the first round price impact, but whether it starts to get embedded into underlying inflation dynamics. So I'm going to be looking at everything, official and private sector, company level data and earnings calls and so on. But what I'm really trying to understand at this point is, do those inflation expectations stay anchored, A, because that's the precondition for even considering cuts, and then B, do we get a material enough weakening in the labor market for the Fed to want to cut, to lean against that, gathering any momentum? I think it may still be a little while before we really get visibility on this, but my hunch is that we'll have a feel for that, how much the labor market is deteriorating by September, which makes it the logical moment to call the next move on rates.
Hi, Krishna. Lori Calvasina from RBC. I've been getting good to see you. I've been getting a lot of questions on small caps, which are related to rate cuts. And I'm wondering, in your conversations, are you starting to see expectations that the Fed is actually going to do something in September? Are those moving up? Are those moving down? There's been a lot of dispersion. There's been a lot of shifts in kind of the vibe on the ground. What's your read of the tea leaves right now?
So the market has, with this most recent sort of patch of weaker data with ADP and with ISM services, markets moved to price in more conviction, high conviction around a September move, and sort of more than 2 cuts discounted through the end of the year. And obviously, if we get more rate cuts, provided that's not in the context of a recession, if that's a moderate weakening that the Fed's leaning against, that can potentially help the small caps and other stocks. But I think we've got to be a little careful interpreting this. I don't think we should interpret market pricing as saying September is anything close to certain. And I say that as somebody who has it as a narrow base case. I think the reality is that there is still very much a pathway here where we end up with no cuts because the labor market doesn't weaken all that much. There's a pathway where we get 2 or 3 cuts, and that's an intermediate case where there's some softening and the Fed's leaning against that as it emerges, but not before it does. And then there's still the recession case. Is that 25, 30%? Is it a bit more, a bit less? And if we do break into recession this year, then the Fed will be cutting very, very aggressively. So remember that the market pricing is essentially the mean average. It's the weighted average of those 3 different paths.
Krishna Guha of Evercore, thank you so much, as always, for joining us today as we parse through the economic data and the ramifications for the U.S. Central Bank. The ECB will be making their rate decision in just about an hour and a half. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with JoAnne and Yahaira.
Hi, Lisa. President Trump says Vladimir Putin has warned him that Moscow plans to retaliate against Ukraine following recent drone strikes deep inside Russian territory. Trump and Putin spoke for over an hour on Wednesday as U.S. efforts to broker a peace deal show signs of stalling. The 2 leaders also discussed Putin's potential role in ongoing U.S. nuclear negotiations with Iran. Meanwhile, for the first time in 6 years, the Indian Prime Minister may miss the G7 summit. This is being attributed to frosty ties between India and this year's host, Canada. Sources tell us that Prime Minister Modi has not yet received an invitation from Ottawa, but officials say Modi is unlikely to attend even if he was invited. India is not a member of the G7, but has been invited to every summit since 2019. And Nintendo Switch 2 went on sale at midnight in one of the biggest global gadget debuts in years. The long-awaited console sells for $450 in the U.S., and GameStop and Best Buy expected to sell out today. The console's success hinges on Nintendo's ability to continue to design compelling games of its own while also accommodating titles from outside publishers. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. It also depends on parents being really patient and wanting their kids to use these things. And I hope if my kids are watching, it's actually been delayed for a long time, so you won't be able to get it. Up next, we take you to the Super Return Conference in Berlin. Orlando Bravo of Thoma Bravo sits down with our very own Danny Berger. Do not miss that conversation about the tech landscape and about mergers coming up. And then, of course, we will be speaking in about 45 minutes' time with House Speaker Mike Johnson here on Bloomberg Surveillance. It's an Initial jobless claims Thursday before payrolls Friday, and we are seeing ongoing strength in equities, if you can call it that, just really grinding a little bit higher. Although as the session goes on, we're seeing the NASDAQ basically flat. Russell 2000 still up 0.1%. We did see a rally in the bond sphere yesterday, which gave some people hopes that maybe it wasn't all hinging on the budget discussion down in Washington, D.C. A lot of people are watching this as it relates to the credit space, as it relates to the investment space, both in the public and private markets. Now we take you to the Super Return Conference in Berlin, where our own Danny Berger is standing by with a special guest. Danny.
Lisa, thank you so much. I am so pleased to say that joining me this morning is Orlando Bravo, the co-founder of Thoma. Bravo. Orlando, thank you so much for joining.
Danny, thanks for having me. It's good to see you.
Well, first of all, great to see you, and congratulations. A more than $24 billion fundraise you just announced this week. And in general, you've been extremely active, selling down your NASDAQ stake, one of the biggest buyout deals with Boeing. But this is a time where this industry has felt really icy and not a lot of movement. So why are we seeing a lot of activity from you and not your competitors right now?
Thank you for bringing that up, and that's one of the reasons I'm here at Super Return. I want to talk to all the private equity funds about this. In our business, you always have to be selling and you always have to be buying. It is actually not a buy and hold forever business. That may be a great strategy, but if you want to do that, you go to the public markets, you get some other types of investors, and you tell them a different story about what you're going to do. For us, we have an extremely clear strategy, and that has two parts to it. Number one is we buy the number one software company in many different categories. And there are hundreds and hundreds of great businesses to pick from, regardless what interest rates are, regardless what the macro outlook is, regardless what the world order looks like. And second, a key part of our strategy is we transform those companies operationally and strategically. And the opportunity for operational gain in software is enormous. One last thing I'll tell you about that. The average publicly traded software company does not make any money. Our average company has a 40% EBITDA margin, and that's the kind of opportunity that we look to achieve.
I'm sure a lot of your competitors would want that kind of thing. So, Orlando, is what you're saying, is this an industry that's lost its way?
Private equity has lost its way in the last 3 years, but it'll come back.
How so? How so?
There are a couple of things. I think private equity leaders have been too concerned about the macro. And I just mentioned that before. Let's predict whether there's a recession, stagflation, what's going to happen to interest rates, what is going to happen once again to the world order. Those are factors that as a business owner, business buyer, you cannot predict, and certainly you cannot control. We have to get down to the basics, which is there are many, many great companies to be bought. And as a control owner and change agent, which our industry is, there's so many companies to transform. Think about it this way. Let's say you buy a company today. Let's say you and I buy a business. And next month, the NASDAQ is up 50%, but our earnings are down 50%. Would you be happy? Now, let's say the reverse. Let's say you and I buy a business and its earnings are up 50% next month. Regardless of what the markets say, you're going to be very happy, and people have to focus and refocus on those fundamentals.
I say one of the big macro issues that affects your world, because maybe you're a little less touched by the tariffs just because software is your core, is certainly AI. And we've seen huge disruptions. You're at the forefront of a lot of it. But even as something as simple as Google search or a mainstay has gotten disrupted by ChatGPT. So when you're doing these really, really big deals for software companies, how do you think about and protect against revolutionary changes that might really hurt some of the software business models?
That's why it's key to be a specialist. In software or in whatever you do, the days of being a generalist in everything, it's too competitive and there are too many disruptions. Now, in the corporate world, in selling software and technology to corporations, and I've said this before, technology is evolutionary, not revolutionary. It does take a while for these corporations to consume technologies. Even today, software as a service companies that should be selling to every single enterprise, it takes about 2 years to convince that company, your customer, of the use case of that application. Do they have budget? What's the ROI? What are the competing choices? Should they build it internally or not? Now, your point on AI is excellent. We believe AI will be transformative. especially to the companies that we're buying. But the companies we're buying have a huge advantage. They have thousands of customers in that use case, and many of them own the data that is heavily important, right, for these powerful predictive models.
Well, I would love to know your thoughts then, because you see this on a ground level. The Anthropic CEO gave an interview to Axios where he said that in the next 3 to 5 years, AI will wipe out 50% of white-collar jobs. Does that sound right to you?
It doesn't. It's a very interesting point of view. It's a very futuristic point of view, but I think it'll make white-collar jobs more productive and people a lot smarter. Think about how we use it personally. I use ChatGPT and all kind of models all the time. I say, hey, write me a paper on this topic, but then I can think a lot more thoughtfully and more deeply about that topic and improve it and spend my time, once again, much better than rudimentary first drafts on something. Look at investment banking analysts. When I started in investment banking in 1992, there was no internet. If we wanted to run comps on a company, we had to call the library department, go get pages and pages of 10Ks and 10Qs, input all of them, and come out maybe 6 hours later with a set of comps. Now, of course, it doesn't work that way, but there's still more investment banking analyst jobs than when I started in the business.
Well, that's good news, I'm sure, for a lot of entry-level people who maybe were concerned that AI was going to take their job. Orlando, I'm afraid that's all we have time for. We could probably do this all day, so I really appreciate you spending the time. Lisa, that is, of course, Orlando Bravo of Thoma Bravo on the changes that this industry needs to do to stay with it. Lisa.
Danny, thank you so much. A wonderful interview, especially that point about artificial intelligence, especially as we parse through the labor market data to try to understand what's behind it, how much of it is technological and how much of it is actually commenting on the macro sphere. Still with us is Lori Calvasina of RBC. I am curious, Lori, how much that underpins some of the difficulty in analyzing the data that we're going to be getting, not only initial jobless claims, but also tomorrow with non-farm payrolls.
In terms of just the AI dynamics underpinning, I'll go back to what I read in transcripts.
All right, transcript junkie.
I know, which is an old-fashioned process. And look, I've been watching for clues in the labor market from a lot of different angles, right? Not just AI. And we've definitely seen some companies that have laid off, in certain areas because they are hiring on the AI side. I would say that's the most consistent trend I've seen. I haven't necessarily seen a ton of that, but I have seen some kind of role switching, de-emphasizing this part of the business to more emphasize on the AI part of the business. To be honest, Lisa, like when we look through transcripts, we kind of divide companies into two cohorts. They're kind of the companies that are in the center of the AI build, and all that commentary, sounds really good, and you get really bullish, and you think this thing has legs and is going to be really powerful. And then you get to like on the other end of the spectrum, the companies that are, maybe your typical retailer, and, maybe not as data intensive. And they'll give you what we call kind of these small potatoes examples, where you're just like, this isn't going to be transformative anytime soon. And there are a few in the middle that are maybe a little more techy, and they're really making progress and having some synergy. So I'm more in the camp that this is going to take time and make people more efficient down the road, but it's not an instant bullet.
Lori Calvasina, thank you so much for being with us as always. Our local transcript junkie, who we are always pleased to have on air, Lori Calvasina of RBC. Annmarie, it's got to be a couple parts that we have today. We have, of course, the initial jobless claims. Before that, we get the challenger job cuts announcements. Throughout the day, we're going to be having a key meeting in Washington, D.C. between the German leader and U.S. President Donald Trump, and, of course, ongoing negotiations over this bill.
Ongoing negotiations over this massive tax and spending bill, although at the moment, really all this does is keep current policy with some cuts on the sidelines. How they get this done in 29 days, I think the timeline is going to be really challenging for the speaker.
I think a lot of people would agree with that, and the market's watching closely. Coming up next, we'll be speaking with Tom Becker of BlackRock, Lotfi Karoui of Goldman Sachs, Dan Greenhaus of Solus Alternative Asset Management, and of course, don't miss this, House Speaker Mike Johnson here in about a half an hour time. This is Bloomberg Surveillance.
From the Fed's perspective, for them to start cutting interest rates, they probably need to see employment growth, not just cool, but really substantially slow down.
If we see any type of weakness in the labor market, that's what the Fed is going to be looking at.
You need the Fed to get in motion. You need the Fed to start cutting rates.
For the Fed, it's going to be very tough to cut interest rates this year.
Our economists expect no cuts this year, 7 cuts next year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Markets looking for direction ahead of initial jobless claims in just about 90 minutes' time, as well as tomorrow's non-farm payrolls report. Ongoing animosity brewing between Elon Musk and President Trump, threatening to complicate the tax and spending bill. Right now, we are looking at a market that is trying to figure out whether Fed rate cuts are a good thing for risk assets or a bad thing, because it means weaker growth. Right now, futures just marginally higher after 3 days of gains. But Annmarie, it seems like the data yesterday indicated that there was a real softening under the hood, which would allow the Fed to cut, but really raises a question about whether people are being overly rosy about growth outlooks.
Right. Are we back to the bad news is good news? Because this means there's a path open for the Federal Reserve. The president certainly thinks so. Those ADP numbers came out. Private sector hiring rose the lowest in more than 2 years. And he said, now is the time to cut. Jay Powell called him late, should have already been cutting. And I think what the market is trying to digest, we've seen all this survey data and this consternation about tariffs and trade. Is that now starting to hit the hard data, or potentially are we still just muddling along and we might be here for the rest of the year?
Well, we also have really neglected the ECB. And I say this to President Trump, who is an avid ECB watcher, as we learned yesterday when he tweeted about the ECB and all the rate cuts going there. Of course, he said there were 9 rate cuts. There have been 7. Today might be number 8. But there is a real question going forward about how long this divergence can continue, where you do see Europe getting a green light from CPI reports, from flash recent inflation estimates, getting a green light from the overall market to cut rates at a time where a lot of people have a question mark around the stagflationary types of reactions in the U.S. economy to what's going on with tariffs.
And maybe President Trump is just foreshadowing the ECB, saying they cut 9 times. You made the point last hour. They've cut actually 7 times, but in 13 months. And what's interesting about this meeting is everyone thinks they're going to cut. No, they're going to cut. That's going to be 8 times. It's that actual 9th time. Do they take this pause for the European Central Bank in the summer? And for an individual like President Trump, who's so excited to see the ECB cutting and thinks the Fed should just follow in their footsteps, they're able to cut because of the policies enacted by him and his administration.
Well, and this really is a question going forward about what the policy mix is going to be in the United States. I can't emphasize enough the July 4th and July 9th deadline is really deliberate in order to create these processes that move in tandem with one another, where the bill directly affects some of these negotiations. How likely does it seem right now? I know you've been talking to a lot of people that we can meet those deadlines.
It's incredibly challenging for the tax bill. 29 days to get all of these senators and House Republicans on board, given the fact that Speaker Johnson had to do gymnastics dealing with all the different caucuses to get all their measures into the bill that many of these senators want to strike down or edit. And then it comes to the trade and tariff story. And I just got back from Europe. What I heard from the top trade official in Switzerland was that she was given assurances by Scott Bessent, the Treasury Secretary, by Ambassador Greer, that if they're still in negotiations but there isn't a hard deal by July 9th, there'll be an extension. So then we're still dealing with a summer of policy uncertainty if July 4th and July 9th come and go and we don't have deals done.
The summer of policy discontent. Right now you're seeing in markets just a little bit of a lift. There was a rally into the bond space yesterday on the heels of weaker than expected data, which seemed to support some of the positive reaction that we saw heading into the close yesterday. Today you see also 10-year yields lower, 4.35%. You can also see a little bit more dollar weakness, 114.28, that just grind lower for DXY and for the euro dollar cross. Coming up this hour, Tom Becker of BlackRock as stocks look for a 4th day of gains. Lotfi, Karoui of Goldman Sachs as Treasuries rally on Fed cut hopes. And don't miss this, the gymnast himself, House Speaker Mike Johnson, on the fight for President Trump's tax bill. We begin this hour with stocks on hold as investors await fresh economic data. Tom Becker of BlackRock writing this: market attention could shift away from trade slowdown concerns and instead focus on a global economy that could be running quite hot this summer. Tom joins us now as it climbs toward 88 degrees today in New York City. Thank you so much for being here, Tom.
I'd say so.
I am curious about how hard it is to push against the recent data that's actually, and I say recent in the past couple of days, been inflecting lower with respect to growth. How much can you say this actually doesn't represent the heat that we're going to see later on?
Yeah, I think
once you had Liberation Day and kind of all of the uncertainty that unleashed over the subsequent month, we kind of downweighted our view of both the hard and the soft data that was going to be coming out April, May. So market reaction yesterday to that services PMI, I think kind of tells you a little bit more about positioning than it does about the economy. Kind of that 10 bip rally in yields, maybe telling you that people are set up short because services PMI has been revised a lot the last few years, and particularly coming in the wake of kind of all that uncertainty. We don't think it's a great barometer.
And this actually speaks to your broader call, which is that you kind of are moving away from the Buy Europe trade and are going back to Buy America, which is counterintuitive given some of the pessimism that we've seen of late.
So I think it depends on which asset class. We still think the dollar trades lower from here. We think U.S. Treasuries underperform global yields. So we think kind of the rebalancing that's been kicked off by the change in Trump trade policies, we think that has legs, particularly on the dollar, where foreigners are going to reassess kind of their aggregate U.S. exposure. We think the path of least resistance is to put in some currency hedges, kind of hedge bonds, maybe a little bit of equities. It's a little bit expensive. You can think of that as insurance. But if you think about U.S. equities at this point, they've been real big laggards year to date. People may be lumping those companies in with concerns about the U.S. economy or the U.S. policy outlook. Those companies are going to earn globally based on their kind of competitive advantages. Weaker dollar is good for foreign earnings. They get to redenominate those foreign sales back into dollars. And Q1 earnings were really quite strong. The U.S. was the place where you got earnings growth, and you're getting multiple expansion in the rest of the world on expectations. Europe in particular, a lot of hope. They had the tax cuts yesterday on the corporate side, kind of more good news. But in terms of the near-term earnings outlook, we think the U.S. is kind of where it's going to be over the summer.
So you think, like many, that the dollar is going to go lower. How much do you think this is actually U.S. policy without them actually saying we want a weaker dollar? Because they, of course, will never say we have a weak dollar policy.
Right. So totally agree, Annmarie. That's, I think the policy is we want a weaker dollar to get some competitiveness on manufacturing, some trade competitiveness. There's a couple challenges with that. One is the interest rate differential. Kind of, you mentioned the ECB is going to be cutting. They don't want the euro going to 120. So you're in this situation where foreign central banks are kind of fighting against their currencies appreciating. So that's going to make it hard to kind of go down on fundamentals if the U.S. growth is strong. But we think the aggregate massive accumulation of U.S. assets by foreigners over the last 5 years, where they've kind of taken all the advantages of getting long equities, long bonds, maybe letting their hedge ratios drift and get more long dollar exposure. That correlation shock you saw in April, I think, was a shot across the bow for a lot of them.
Do you think where currencies are trading is part of the trade negotiations?
I mean, the bilateral negotiations, there are certainly, I think, some Asian countries that are looking to kind of throw that in the mix. Some Asian economies for years have kind of had, we call them dirty floating exchange rates, where they manage them pretty closely. The fiscal and the monetary and the government all kind of coordinate to keep the whole economy competitive. So I think that is potentially bilaterally part of the negotiating.
In the meantime, you have this counterintuitive argument, and I love that, about the way that you try to shift in markets where you're pushing against this idea that the U.S. is going to be the most hurt by some of these tariffs. That seemed to be the idea maybe a week ago, 2 weeks ago. Yeah. It has been the theme that's caught wind over the past couple of weeks. Why do you think it's actually emerging markets? It's actually even Europe.
So in terms of who builds the stuff that Americans buy, over time that has shifted abroad. And we think that there's a real reason now to bring some of that production back home. And so some of the uncertainty that's maybe held back investment the last few months, we think there's a good incentive for producers globally that have factories in the U.S. and abroad to run the U.S. factories hot, right? Like there's a mechanical price incentive to do that. So that's one thing. And the other is I think the U.S. consumer, U.S. innovation, those are really the lifeblood of the economy at the end of the day. And so firms want to locate here in order to access U.S. consumers, to access the human capital, to access the huge unified market. You go to Europe, you have to negotiate with 25 different little regulators. I mean, this is a topic that keeps coming up. The U.S. has this enormous, powerful consumer that is kind of bound by the same rules and principles. I think that's a real benefit.
Do you think Trump's policies are helping that reshoring back into the United States?
I think that the first Trump administration started it. So if you look at kind of import share from China, it's been declining since 2017, 2018. A lot of it went to Mexico and to kind of the near-shoring, the friend-shoring. I think this round of tariffs maybe makes people think, oh, maybe get a little bit closer even still. And so, yeah, I do think that kind of corporate America had a playbook that was working after China WTO ascension. That playbook's probably not the right playbook for the next decade. And so I think corporate executives, when they decide on their sourcing decisions, are just going to shift them closer to home. And so I think it will have effects.
One thing that I find so striking, and just I'd love a final word on this, the idea that Morgan Stanley was raising that you seem to be reiterating, which is you could see U.S. stocks do well. You disagree with them on U.S. rates. You think that U.S. rates won't necessarily do so well and that yields could stay high, but the dollar will be weak. And that's going to be the ongoing theme maybe for the foreseeable future. How much is this out of consensus right now?
The dollar, I think, is getting more into consensus, but the dollar is an asset that tends to trend. And that's because a lot of huge organizations globally make their decisions on these FX hedge ratios and policies, not on a daily meeting or a weekly meeting. These are quarterly, annual stakeholder type meetings. And so I think it can trend kind of for that institutional reason. In terms of the U.S. equity outlook, that's going to be about the earnings. And so if U.S. consumers consume, which they did in the first half, they didn't get unsettled by this. I think you can have U.S. companies put up really strong earnings, and a lot of it is beating expectations. And so the expectations have shifted abroad, positioning shifted abroad, and so it's a little bit the underdog, which is an interesting place to be.
Tom Becker, thank you so much for being with us. Really appreciate it. Thank you. Tom Becker of BlackRock here in our studio. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with JoAnne and Yahaira.
Hi, Lisa. The U.S. Education Department says Columbia University no longer meets accreditation standards due to its violation of federal anti-discrimination laws. It's the latest effort by the Trump administration to target elite schools over their handling of pro-Palestinian protests. If it fails to come into compliance, students' access to federal student loans and Pell Grants would be impacted. Meanwhile, Elon Musk is ramping up his fight against President Trump's One Big Beautiful Bill, asking Americans in a post on X to call their lawmakers and kill the legislation. Sources telling us here at Bloomberg that Musk personally lobbied House Speaker Mike Johnson to save EV tax credits in the bill, which would have benefited Tesla. Speaker Johnson will be joining our show at 7:30 this morning. And Alphabet CEO Sundar Pichai says the Google parent company won't stop hiring despite advances in artificial intelligence. Pichai spoke at the Bloomberg Tech Conference in San Francisco.
There's no doubt to me that 3 years from now, there'll be a company which will be dominant in this AI age, which we don't even know the name of today.
Pichai also said whoever runs Alphabet in the future will have an extraordinary AI companion. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. In the market for an AI chief financial officer. Up next, betting on a slowdown.
From the Fed's perspective, for them to go ahead and I think start cutting interest rates, they probably need to see employment growth not just cool, but really substantially slow down and maybe even become negative.
Lotfi Karoui of Goldman Sachs joins us next on what that means for credit, what that means for rates at a time where President Trump is saying to the Fed, too late, Powell needs to cut right now. This is Bloomberg Surveillance. Maybe trying to get a fourth day of gains. Good morning. Welcome back. Right now in markets, we're seeing a bit of a lift, although it's fading throughout the morning. And now we've turned negative. The Nasdaq now down about 0.1% after being up about 0.1% or more earlier. The Russell 2000 also has fallen about 30 basis points in the past couple of hours. Meanwhile, in the bond space, and this is something that we really are watching after yesterday's rally, we saw the biggest rally in 30-year yields yesterday, going back to February. 10 basis point decline, and that continues this morning, down 3 basis points, 4.85%. You can see this across the curve, but more notably in duration, 10-year yields lower as well, 4.34%. Under surveillance this morning, this is what's behind it, betting on a slowdown.
From the Fed's perspective, for them to go ahead and I think start cutting interest rates, they probably need to see employment growth not just cool, but really substantially slow down and maybe even become negative. It's the labor market that matters most because that's going to drive consumer spending, and that's really the bulk of our economy.
Here's the latest. U.S. Treasuries gaining as traders bet the Fed will cut rates in September. Weaker ADP data raising expectations of a slowdown ahead of U.S. payrolls tomorrow. Lotfi Karoui of Goldman Sachs joins us now. Lotfi, I am curious about how much the rally yesterday gives you some sort of confidence in Treasuries, given the fact that it was ADP. Everyone dismisses this data, and then suddenly it has become the rationale for why there was a rally in long bonds.
Yeah, I mean, look, I think it's a great reminder that treasuries have not lost their edge as a hedge against the state of the world in which growth decelerates. And so I do think that you still want to own duration going into a slowdown. And I also think we need to sort of frame things a bit differently, which is there a floor on the term premium because of the current and the forward outlook for, the fiscal situation? And the answer is yes. If we have a recession tomorrow, it's highly unlikely that 10-year yields will go back below 2%. But with that being said, yields will go lower as sort of growth slows down. And I think from a multi-asset standpoint, you still want to keep a little bit of exposure to duration to protect yourself against that state of the world.
So just to put sort of a floor under what you're saying, because this is really important. A lot of people, and we're going to be speaking with House Speaker Mike Johnson coming up, they're going to argue, look at what happened yesterday. When economic data turns negative, people go into long bonds, and this has nothing to do with the budget down in Washington, D.C. This has to do with a global move. It has to do with more optimism about the U.S. economy. You're saying, it's a bit nuanced. There is a term premium, but it doesn't mean that these assets will not rally in some sort of negativity. Is that what you're saying?
Absolutely. And I think, if I think about corporate credit or mortgages as an example, you look at the base yield and you decompose it into spreads and treasury yields. Spreads are a very tiny portion of the total right now. And so de facto, obviously, when you own treasury bonds, you're long duration, but you're also long duration if you own corporate credit, if you own mortgages, et cetera. And I think what that tells you is that the bar is still very high to derail price returns because of that negative correlation that kicks in whenever you have a negative surprise in growth. And I think tomorrow will be very interesting, by the way, because you're right. ADP usually doesn't move markets that much, and it did yesterday. We'll see what happens tomorrow.
What do you make of this, what Lisa's talking about, this idea that what we're seeing in the bond space is a direct correlation to the discussions when it comes to the one big beautiful bill and the expansion of the U.S. deficit?
To some extent, yes. I think that sort of puts a floor on the term premium. You have to think about it, if you owning duration for the next 10 or 30 years and you look at the fiscal outlook, you are supposed to demand a higher risk premium, all else equal. But that doesn't mean that treasuries have sort of completely lost their edge as sort of, yields moving lower and, as growth decelerates. And so I think there's a difference to me between the two. And then also, there's a relative value view that you can make, which is which point of the curve do you own? Is it 10? Is it 30? Is it 5? I sort of like the 5-year point of the curve. I think there are question marks about the 10 and 30-year.
Well, a lot of analysts have been coming on this show saying they'll stay away from the 30-year, and some are even shorting it. Do you think that potentially they're on the wrong side of the boat? Shorting it outright, I don't like that. I wouldn't be short duration going into a slowdown. Shorting it relative to the front end, 2s or even, shorter than that, I don't disagree with that view. I mean, the steepener view, unfortunately, became a consensus view today, so you have to be mindful of that. But I do think in relative terms, there's room for underperformance.
What do you make of the fact that auctions are becoming great, for lack of a better word, or greatly important to markets? They've become risk events. We saw Japanese auctions suddenly making front page business news in the United States as people look to weaker demand, but not as weak as expected. And then next week we have 10-year and 30-year U.S. auctions. How important are they, or is this just a fiction that people have created to try to give them some sort of drama over the summer?
It's interesting because you usually see that type of behavior in corporate credit markets, not in sovereign debt markets. And so the short answer is it is evidence that there's some kind of a fiscal premium that's building up. The fact that these auctions are getting so much attention, globally, yes, of course, it tells you that there is some kind of a fiscal premium. And again, it goes back to the point I made earlier. That fiscal premium will not die out, even if growth slows down.
What does that fiscal premium do to the corporate premium? And I say this because ultimately corporate credit is pegged as a rate to this government bond yield. It has that. Is there a point at which corporates will seem more responsible than governments? And you could
They
actually...
have been the last 5 years. Actually, if you look at net issuance in IG or in high yield for that matter, corporations have acted in an incredibly disciplined way from a capital management standpoint. And so we have yet to see evidence of any crowding out, where actually corporations are issuing more as, the Treasury and other sort of, jurisdictions are dumping more bonds to private investors. So I would say the takeaway from me is that, governments have been sort of, spending more the last 5 years, but corporations and households, by the way, in aggregate at least, have been acting in a fairly disciplined way.
Speaking of government issuance, Nouriel Roubini in the Financial Times this morning in the opinion piece is talking about activist Treasury issuance, which he said started with the Biden administration under Treasury Secretary Yellen, but said even though he wrote this paper with Stephen Myron, who's now in the administration, he thinks it's going to continue under the Trump administration. Do you agree?
Yeah, I mean, look, we'll see where the bill, eventually gets to. But yeah, I mean, the fiscal outlook does point towards more supply in the Treasury market. And I think there's on the short end, and there's, plenty of ways you can play that view. You can play it, in terms of like synthetic versus cash, the bases, et cetera. But yeah, I mean, based on what we know now, that will likely continue.
Going forward, I am curious. You were talking about issuance on the government side and issuance on the corporate side, and I want to finish there.
Yeah.
Typically, companies borrow for general funding, but also for expansion, for mergers and acquisitions. And that activity really hasn't been as great as people expected because of the uncertainty that we've seen in policy. And I wonder how much you see that reviving later this year versus remaining on hold as people understand, wait a second, I don't know if we're going to hit these deadlines or if it's really going to mark the end of uncertainty.
Look, to see a boom in M&A, you definitely need to see resolution on uncertainty. But I would say the year-to-date trend isn't as bad as people want to describe it sometimes. Actually, in dollar terms, we're up relative to last year. And granted, 2024 is a low base. In count, we're also up. I think what matters for bondholders is really the funding structures more than anything else. How much leverage are you going to deploy in these transactions? I would say if you believe that we're in for high for longer cost of capital, that sort of makes the economics of a leveraged transaction a lot more challenging today than it was in 15. And so I am positive that once we clear this sort of uncertainty, we'll see, continued rebound in M&A. I don't think the funding structures will be as hurtful to bondholders as they were back in 15, 16, 17.
So basically, you're going to get compensated and it's not going to be as risky. So it looks good.
I don't think so, because the cost of capital is still too high.
Right. Yeah. Lotfi Karoui, thank you so much for being with us.
Thank you.
Really wonderful to see you. Lotfi Karoui of Goldman Sachs there as we do plan for next week's 10-year and 30-year bond auctions. I hear that, Annmarie, you are incredibly excited about that.
Not really. I'm more excited to hear your take on them. I guess it is interesting, though, when you read Nouriel Roubini's piece, which he was expecting a different cadence of issuance, maybe towards the longer end, because you saw individuals in the current Trump administration really go after Treasury Secretary Yellen, saying what she was doing was activism in terms of the yield space. They're actually following the same path.
Well, because at a certain point, if you issue more of what people don't want, you're asking for an accident. And I think that's partly what people are saying. Maybe even reduce the amount of 30-year issuance altogether across the world just because there has been a lack of appetite for them. At the end of the day, how do you deal with long-term funding issues at a time when you have relatively elevated funding costs? And the answer is it's going to be really, really difficult. But we can talk about that coming up with House Speaker Mike Johnson, who will be defending President Trump's one big, beautiful bill as it faces opposition in the Senate. Also from Elon Musk, first buddy, coming out and saying to people, you recommend that he calls people to call on their Congress members to kill the bill. A real question here about what the road is ahead and how important it is to get done by July 4th. This is Bloomberg Surveillance. Well, early optimism had soured just a touch, at least in equity space. We see futures just marginally lower across the board as we await some key economic indicators. Not only do we get initial jobless claims any second, we also get the challenger job cut announcements. Tomorrow we have non-farm payrolls at a time when we did get ADP data that came in at the lowest in about 2 years. You saw that bid into bonds as a result yesterday. The bid into the long bond in particular, particularly sharp, 10 basis point decline, the most going back to February. Continuing that today, 4.85% in the 30-year space, down about 2 basis points in the 10-year space at 4.34%. You bleed this through currencies. Euro ascendant, 114. North of that, you've got the dollar weakness continuing to persist. The one theme that has been consistent throughout what we have seen. Meanwhile, Elon Musk is ratcheting up his offense against President Trump's signature tax legislation, urging Americans to press lawmakers to kill the bill. House Speaker Mike Johnson saying Musk is dead wrong, and the Tesla CEO vowed to help re-elect the House Republican majority just a day before slamming that bill on X. I am curious, Annmarie, how much this really torpedoes some of the momentum that had been underway in the Senate, or whether it kind of is irrelevant based on the ongoing tit for tat on the specific issues.
Well, I think Elon Musk, Ashley, now just gives some credit potentially to those that are saying they're concerned about the deficit, but also potentially those on the Senate side that are saying they want to see these green energy tax incentives continue. And yesterday, Speaker Mike Johnson said that basically this was a 180 from where Elon Musk was, and he said he was going to call Elon Musk. Elon Musk didn't pick up, but he was waiting for him to respond. And we can find out whether or not Elon Musk actually did respond to the speaker. House Speaker Mike Johnson joins us now. Thank you so much for your time this morning. We'd love to begin there. Have you received a call back from Mr. Musk?
Yes, Elon's a good friend. We texted late last night. We're going to talk this morning. I just want to make sure that he understands what I think everybody on Capitol Hill understands. This is not a spending bill, my friends. This is a budget reconciliation bill. And what we're doing here is delivering the America First agenda. This is all of the president's priorities and all the priorities of the Republican Party. Everything we promised the American people, that is what we are delivering with this piece of legislation. And the reason we're using the reconciliation process is because that is the only way to get around the 60-vote threshold in the Senate. Everybody probably recognizes Chuck Schumer and the Democrats are in no mood and not going to be helpful in delivering President Trump's agenda for the people. We have to do it this way. We can do it with 51 votes in the Senate only, and that's the urgency of the hour. And we have to do it quickly for all the reasons we can discuss this morning.
So did you get a sense from Elon Musk in those text exchange that he was going to stop his insistence on this bill that he thinks needs to be killed?
He seems pretty dug in right now, and I can't quite understand the motivation behind it. But I would tell you that what we're delivering in this bill is not only historic tax cuts, but historic savings as well. He seems to miss that. I mean, the projection is that this legislation is going to save us $1.6 trillion with a T. Now, there's never been a piece of legislation ever delivered in the history of government on the face of the earth that saves that much money. So this is truly historic. Now, is it enough? No, because all three of us understand that we have a large federal debt. We've had deficits for some time, and it's a serious concern. In fact, it's the number one threat to our national security. But this is the biggest step in addressing that problem that Congress has ever delivered, and we must do it. And I will hasten to say this. I've told Elon and tell everyone, this is the first of a series of steps that we will take to bring that debt under control. But you can't turn it on a dime. It took us decades to get into this situation, so we have to do it incrementally, and this is a huge step forward in that endeavor.
What's the driving force behind Elon Musk's problems with this bill? Has he asked you directly to potentially keep the electric vehicle benefits we saw under the Inflation Reduction Act of the Biden era into the bill?
Look, I'll let everybody draw their own conclusions about Elon's motivations. I'll tell you that, I mean, obviously the EV mandate going away is I'm sure a concern for the leader of Tesla. And other things as well. But I think there's a lot of confusion out there about what the legislation is. There's certainly a lot of misinformation. I mean, the Democrats have been engaged in this effort, this strategy for many, many weeks and many months. But remember, it took us over a year to develop this piece of legislation. We have 11 different committees in the House, all their areas of jurisdiction. that worked on the reconciliation effort to reconcile the budget. And what we're going to deliver here, again, is historic tax relief and savings at the same time. If we do not get this bill done, the tax cuts of 2017, the Tax Cuts and Jobs Act, will expire at the end of December. Every American will receive the largest tax increase in U.S. history all at once. It would be devastating for the economy. So we've addressed that here. We've made the tax cuts permanent, and we've infused it with a pro-growth series of policies that will get the economy going again. It will be jet fuel to the economy because we're going to reduce wasteful spending, we're going to reduce taxes, and we're going to reduce regulations as well. And that is what will allow job creators in the energy sector and everyone else to get going again.
And your version of the bill, of course, increases the SALT deduction cap, which yesterday Senate Majority Leader John Thune said, quote, there isn't a single Republican senator who cares much about the SALT issue. You and I both know you cannot pass this bill without increasing the SALT deduction cap. How do you envision, though, that deduction changing, given the fact that no senator, Republican senator, wants a vote for this?
Well, I appreciate that they don't. They all come from red states, right? As do I. And we have very different perspective on SALT than our colleagues in the blue states, for example, in California and in New York and New Jersey. But that is the reality in the House, remembering, and they have to remember, my Senate friends and colleagues have to remember, I have to deliver 217 votes to get that thing across the line if they modify it. So I had lunch with my Senate friends Tuesday last, 2 weeks ago, before we passed the bill in the House on that Thursday. And I encouraged them to modify it as little as possible, right? Because I gave a metaphor. I said, my friends, I am crossing the Grand Canyon on a piece of dental floss, okay? The equilibrium that we reached here took quite a bit of time to get to where we are. And you can't load me up on either side. And if you go and slash the SALT cap that we negotiated carefully for over a year, it's going to make it very difficult for me to deliver the necessary number of votes. Remembering, I can only lose 3 in the House. They can only lose 3 in the Senate to get this done. So we're all working together. It's one team, House and Senate together, united in this effort.
Yeah.
They understand that, and I think they understand, certainly Leader Thune and the leaders over there understand the complexity of what we're having to deal with here.
Speaker Johnson, just to sort of put a bow on it, so 40,000 still likely to remain the cap?
That's what we negotiated here, and I'm certainly trying to hold to that number. And look, we've paid for it. I think we've got it worked out in all the math and the legislation, and I think it's something that I know they're not in love with it, but I certainly hope they'll tolerate it so we can maintain our vote tally over here.
Speaker Johnson, as you walk that piece of dental floss over the Grand Canyon, there is this question of how the bill is currently being used, whether it's for budget negotiations and budget reconciliation over the next decade, or whether it's to negotiate trade agreements. There is $2.8 trillion of revenue that is being penciled in by the Congressional Budget Office from tariffs that might be used as a negotiating tactic, might not be. How do you understand the way that tariffs are looked at as part of this budget balancing act?
Well, it hasn't been included in the calculations, and that's because groups like the CBO, the Congressional Budget Office, as you noted, won't give us any credit for that. But it is very real. I mean, the revenue is real, and it is realized, and it's not included in the calculation that we've made or they've made, but obviously it's a big factor. We believe that we're going to bring about a roaring economy again, and it's not based on conjecture or groundless optimism. I mean, this is based on the history. We did this in 2017, and after the first 2 years of the Trump administration, when we passed the Tax Cuts and Jobs Act, we reduced taxes, we reduced regulations, and the economy was roaring. I mean, you all remember before COVID, we had the greatest economy in the history of the world. I mean, everybody was doing better, every demographic. Wages were up, the job participation numbers were at record highs, inflation was down and manageable, things were going great, and then COVID hit. So we're going to do that same series of policies, implement that same philosophy, but this time, as I say, on steroids, and it's going to make a major difference for in everybody's lives.
Speaker Johnson, a lot of people in markets are concerned about a number of provisions here and actually don't think they will spur growth. One of them being Section 899, which talks about taxing foreign investment in the United States from specific countries that have non-tariff barriers like the VAT tax and other things that have been contentious during negotiations of trade deals. How much do you see that dampening? I mean, is that a concern for you? Because right now, around the world, there are people wondering whether they can still invest in the United States without getting penalized for it.
Yes, look, there's a complexity to the tariff negotiations. I mean, we tip our hat to the White House, and the president's strategy is working. As you know, there's more than 75 countries renegotiating their trade agreements right now, finalizing that even as we speak. That's going to be better for America because it will be more fair. You know, I'm always liken myself to be a Reagan Republican, and free trade is one of our core principles that we've all, you know, supported over the years. And every time I would say that over the last several years to President Trump, he would say, yes, free and fair trade. And he's right. I mean, this is a disparity that must have needed to be addressed, and it has been. So we think in total this is going to be good when all the dust settles on the tariff negotiations and the new trade agreements. It's going to be good for America and good for the world. And so we're factoring that in. We're working in tandem with the White House, and it's part of the thought and the calculation and the legislation.
Speaker Johnson, just to be clear, that provision will stay in. That is important to you.
Look, I think it is. I mean, obviously the bill is still a live instrument that's being worked on in the Senate, so we'll see if they modify those provisions. But I think for now, I think that's good policy for us. And I want to say to foreign investors, you're in good stead to invest in America. This is the time to do it because the American economy is about to take off again, and it's going to be good for you and good for the world. We're the largest trading partner for most other nations. They need America, and a strong America is good for the whole world, and that is what we are going to bring about with these sound policies and pro-growth initiatives.
Speaker Johnson, you and your colleagues have a self-imposed July 4th deadline. Partially that is because you have to raise the debt ceiling. Are you considering raising the debt limit if this deal isn't finished by July 4th with a different measure?
Well, it'd be very difficult to do it. I mean, it would require a bipartisan measure in that regard, and I would like to believe that Chuck Schumer and the Democrats in the Senate would do the right thing, but I wouldn't count on that. That debt cliff, as we're regarding it, is coming soon, and that's why Secretary Besson has said we've got to get this done by Independence Day, and I think it'll be a great celebration for all of us. But it's not just because of the debt ceiling. It's also because we need to get tax relief and this new roaring economy to the American people as quickly as possible. They're owed that. And this is going to be a great thing for everyone. And, you know, I have to also think about the politics of it, right? We have a midterm election coming up in 2026. If we get this done soon and quickly this summer, then everyone will feel those effects before they have to go vote again in that midterm election. We want to keep the House majority and keep this going for 4 years for President Trump and not 2. And if we lost the majority, there's no doubt that the House Democrats would try to impeach the president, and everything would be truly chaotic for investors and job creators and consumers. So we have to keep this going, keep the momentum going. The timeline's very important, and that's why I put this on a very aggressive schedule. I said back in the early part of this year that we would pass the big, beautiful bill out of the House before Memorial Day. And people laughed. They mocked me when I said that, but we beat it by 4 days. We're going to stay on track, and we're going to deliver for the American people.
Well, you have exactly 29 days to hit that deadline. Are you saying there's no plan B for raising the debt ceiling if this bill is not done between House Republicans and House senators?
Look, Republicans in the House and Senate will deliver, and we'll take care of our business one way or the other. But I'm just telling you, the smartest and most efficacious way to do this is to stay on this schedule and deliver for the people. And that's what we're doggedly determined to do. We're laser focused on it. And if we take our focus off of that, then the strategy doesn't work. So I'm telling you that we are working on that regard. Leader Thune and I are in constant communication. He understands that deadline as well. The Secretary of the Treasury and the NEC and all the leaders in the White House and the administration understand that. So we're going to get it done.
Speaker Johnson, how closely are you watching the bond markets right now, given the fact that we've seen a real sense of concern, particularly in longer duration U.S. Treasuries?
We watch it closely. Look, I really do believe that delivering this historic legislation is going to be critically important for a lot of reasons, not the least of which is that Congress can send a very important signal to the bond markets, to the stock market, to investors everywhere, that we're very serious about this, not only in getting the U.S. economy roaring again, but also in addressing the long-term debt. And I think that's an important thing for everyone to understand. We have a strategy that's a multiple steps, as I said, multiple step strategy to address this over the next year, 2 years, 3 years. And we're going to get the U.S. economy back on sound footing. We're the party of fiscal responsibility, and you'll see that demonstrated day after day here.
House Speaker Mike Johnson, thank you so much for being with us. It was really great to hear how this is going on your no-sleep schedule as you careen toward July 4th. There is this question about all of the machinations that have to go into walking that piece of dental floss over the Grand Canyon.
It's incredibly challenging when you have a SALT caucus, you have individuals that don't want to see cuts to Medicaid, when you have deficit hawks, and he's laid out the math right there. The math is incredibly challenging, even more so for him than Senate Majority Leader Thune.
Up next, we'll continue the conversation with Dan Greenhaus of Solus Alternative Asset Management, as bonds do get a bid, and it doesn't necessarily have to do with what's going on in Washington, D.C., but rather economic data pointing to a bit of a slowdown. This is Bloomberg Surveillance. Some of the optimism fading as we fail to at least get an early 4 days of gains. Right now, futures lower after being higher earlier, at least in the Russell 2000. They've been flipping and flopping, basically steady, a turn under the hood here as we are so close to a bull market, 3% away from all-time highs on U.S. equities. In the bond space, a rally as people look toward non-farm payrolls after the ADP print and after a less than terrible auction in Japan. 30-year yields, the lowest or the biggest rally yesterday going back to February, down an additional 3 basis points this morning. Under surveillance this morning, delivering the American First agenda.
This is not a spending bill, my friends. This is a budget reconciliation bill. And what we're doing here is delivering the America First agenda. This is all of the president's priorities and all the priorities of the Republican Party. Everything we promised the American people, that is what we are delivering with this piece of legislation.
Here's the latest. House Speaker Mike Johnson reaffirming his commitment to passing President Trump's big, beautiful bill. Bloomberg's Tyler Kendall joins us now. Tyler, what's on deck today, and what are some of the big takeaways as we understand how likely it is for them to get a deal?
Yeah, hey, Lisa. Well, we're going to have to see if Elon Musk and House Speaker Mike Johnson end up having that call that he alluded to, as he says that Elon Musk is, quote, pretty dug in here when it comes to his criticism. But Mike Johnson also said that he thinks that he can convince Musk that this is the first in a series of steps to address the deficit, and that could get him on board, even as the CBO released a new analysis yesterday that shows that the House bill, as it currently stands, would add about $2.4 trillion to the deficit over the next decade. Now, a person familiar did tell us that Musk appealed to Mike Johnson directly to save some of those clean energy tax credits. We know that that actually has some Republican momentum, so that's one thread that we're going to be following here. But one of the big takeaways I had from that interview, Lisa, was when you asked him if he's watching the bond market, and he said he was, his answer actually tracked similarly to the answer I got when I posed this question to Senate Majority Leader John Thune yesterday, which is essentially that Republicans are trying to say that ultimately this will stabilize that debt to GDP ratio, and that will be more important if they are able to implement those policies they say will grow the economy. But there's already starting to be questions about how some of these tax provisions in particular will incentivize growth, and you asked him about one of them, Section 899, the so-called revenge tax. And it was interesting to hear him say that that could end up making its way into the final version.
Tyler Kendall of Bloomberg, thank you so much for that. Joining us now is Dan Greenhaus of Solus Alternative Asset Management. And Dan, following that discussion that we just had with House Speaker Mike Johnson, there's a question about how much the bond market has been sending a signal to Washington, D.C. versus pricing in more positive growth. What did we learn yesterday from the rally that we saw, and what actually spurred it?
I actually don't think we learned anything.
Right.
Very easy. But I've had a differentiated view on this. I'm not sure that the bond market is in any way signifying a problem with spending. And we've made this point on the show before. This is a story that we've heard for decades and decades and decades. And I, again, went back and I like to look through old newspaper articles of people talking about the unsustainability of the debt in the 60s and the 70s and so on. 434 on the 10-year right now, let's call it 450, doesn't seem to me to have a problem with the level of spending in the government, nor does it signify to me really that there's any either growth or inflation concerns. It's just like a perfectly benign number in the Treasury market. That's not to say that we don't have a spending problem, because we clearly do. And it's not to say that we don't really need sustainable, meaningful adjustments in spending levels going out in years 5 through 10, which we currently do not have. But it does tell me that there isn't much of a problem now. And when I hear people tell me the bond market is telling, I don't see it.
So do you think there's any problem at all in the bond market?
No.
But it's just not coming from policy?
Again, 430, 450 on the 10-year just doesn't seem to me to be problematic. Obviously, as Lisa just mentioned, the equity market is basically back to a high. So that doesn't seem to be having a problem. Listen, I think at the end of the day, the U.S. government spends too much money. We know that. But we also know that we have tremendous taxing capability. We have tremendous assets that we could sell. We have tremendous ways of servicing the debt. Now, don't get me wrong. I don't want to, if viewers are out there thinking I'm sanguine about the level of the debt, it's gross. I don't like it. I wish we did something about it. My point is just I don't see evidence that financial markets have a problem with it.
So there are two ways to think of this. On one hand, you could say, okay, well, then the move that we've seen in bonds is no problem whatsoever because it reflects positivity in the underlying economy.
Oh, yep.
Okay. On the flip side, we could say that it's a distortion. And it's people being overly optimistic at a time where the economic data is starting to turn lower. And frankly, there is going to have to be some sort of response. So if you don't think it has to do with the deficit, do you think that this bond market has been correct in pricing in faster growth and faster inflation, or do you take the other side of that and really say, actually, there is something else underfoot that we're starting to pick out in the data?
Well, I think, listen, there's three things, and it's usually a little from column A, a little from column B, and I'll introduce column C. Column A is, listen, is there no deficit concern? I mean, I'm probably being a little hyperbolic. Surely there are some corners of the market that think, call it $55 trillion in debt over the next 10 years in total is a little too much. Is there some of this that's growth? Undoubtedly, the data continues. I've been fighting with people on TV about the strength of the U.S. consumer for 2 years now. We continuously use the word surprisingly. It's not surprising. The economy's doing fine. The consumer's doing fine. The third part, which I think is reasonable and doesn't really get very much attention at all, is the shift in ownership of the bond market, which is partly by design, away from what I call price-insensitive buyers, let's say central banks and pension funds, insurance companies, and towards more price-sensitive investors, hedge funds or more trading-oriented individuals and organizations. That's probably going to put upward pressure on the term premium, as we've seen already happening, which over time is going to put upward pressure on yields. And I think that's a story that's going to play out over many quarters, if not many years, as the inflation and the tariff and the spending story unfolds. But I don't think that story, which may be every bit as important, if not more important than the growth and the deficit side of the conversation, I don't think that really gets enough attention and may, if I'm right, over the next couple of quarters.
But isn't policy in Washington, D.C. exacerbating that exact problem? The fact that we're in a number of trade negotiations and with China, an absolute trade war?
Yeah, that's fair. I think the bigger issue, as articulated most prominently by Stephen Miran, is just the dollar is too high. Part of this larger story about the appeal of the United States, the reserve currency, et cetera, which attracts capital inflows. This is Section 899, which you mentioned in the previous segment. All of this feeds into the desire to hold risk assets. And if, as I mentioned earlier, there's a shift going on here where the U.S. is on the margin less desirable, and I'm not sure that that's happened just yet, that's going to put upward pressure on yield, downward pressure on valuations, which is a larger story. But I think that larger argument about the desirability of the U.S. as a destination for global capital flows, the appeal of the dollar, the appeal of the treasury market, which dwarfs every other market in size, by the way, so there's not exactly a clear substitute in the short term.
Yeah.
That's, I think, is a story that we need to spend more time on.
Dan Greenhaus, we'll spend more time on it with you, and you come back next time. Thank you so much for being with us.
Thank
Dan
you
Greenhaus
always.
of Solus Alternative Asset Management. Coming up in the next hour, Nela Richardson of ADP, JoAnne Feeney of Advisors Capital Management, Jordan Rochester of Mizuho, and Krishna Memani of Lafayette College from New York. This is Bloomberg Surveillance.
If things stay status quo, then I think you have the opportunity to see the markets move higher.
Since around mid to late April, it's been the mega cap tech companies that have led.
Volatility could remain elevated, but it's not necessarily an environment where you want to sell all equities.
I would not be adding a lot of equity risk to this rally.
The broader market is really driven by growth in technology, and growth in technology is okay right now.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks churning as traders try to figure out what the jobs data really means for the forward trajectory of the U.S. economy. Is it the data or is it the policy? D.C. still hashing out the taxation and spending bill as Elon Musk expresses his discontent with the legislation. Annmarie Hordern alongside me as always, and I am curious about how much what we heard from House Speaker Mike Johnson really underscored the fact that he was sleeplessly trying to get through something that a lot of people have a lot of problems with.
A lot of people have a lot of problems with, one of them being Elon Musk. And the speaker just said there to us, Musk is digging in, is how he views the situation right now. He did say that the two of them were texting last night. And it feels like Elon Musk is not going to stop on this crusade and trying to kill the one big beautiful bill. And then you pushed him. You're like, where is this coming from? Is it really the deficit? Or is it the fact that maybe the House version of the bill is sunsetting those green incentives from the Biden-era Inflation Reduction Act? And he says, I think you should all draw your own conclusions. We do know that he's at the helm of one of the biggest EV makers in the world. So I think you were able to read between the lines there on potentially what the Speaker's office think the problem is right now with Elon Musk.
And we are so lucky this hour because we have alongside us Nela Richardson of ADP after that report yesterday spurred a response from President Trump talking about how maybe it was time for the Fed to cut. We did see a number that was much lower than expected on ADP yesterday, which signaled that maybe there is a significant cooling in the labor market. Nela, you are the perfect person to give perspective into this. How much is that a valid reading of those numbers?
It is clear that hiring momentum has slowed. First of all, good morning. It's great to be with you. It's clear that the hiring momentum has slowed from the beginning of the year. 37,000 is the lowest we've seen at ADP since March of 2023. What's also clear is that there is enough resilience in this labor market to spring back. If you look at wages, and we calculate a lot of wages at ADP, you'll see that there is still strength in pay gains. That means there's still efficiency, productivity, and companies are keeping their workers in this labor market. So it's a tale of two. Slower hiring, but still a lot of resilience.
Well, this really speaks to the churn under the hood, and that is what we're seeing right now in markets with equities just trying to figure out which direction to go in after 3 straight days of gains. Still, we do have to remind you that we're about 3% away from all-time highs, and we potentially are on the cusp of a bull market. So people not necessarily taking extra heat there. In the bond space, you do see a bit of a rally at the long end, which is completely different than what we had seen for the bulk of this year, particularly at the 30-year yield. The risk asset that yesterday saw its biggest one-day move going back to February, down an additional 3 basis points, 4.85% today. Coming up this hour, we've got JoAnne Feeney of Advisors Capital Management with the S&P 500 on the brink of a bull market. Jordan Rochester of Mizuho with an ECB rate decision around the corner. And Krishna Memani of Lafayette College reacting to the latest economic data. But we begin this hour with stock steady following 3 days of gains. JoAnne Feeney of Advisors Capital Management writing trade policy risks have worsened and uncertainty is here to stay for a while. JoAnne joins us now for more. JoAnne, thank you so much for being with us. I'm curious what your takeaway is from trade policy versus economic data. Is it true that the market can only focus on one at a time, or is there a sense that the economic data will ultimately trump a lot of the policy uncertainty?
You know, Lisa, I think it's the earnings data that could trump policy concerns. Clearly the tariff risks have not gone away. We've got that doubling of the steel tariff, which is a significant input to a lot of industries. That's a problem. So we have the tariffs that are outstanding. We have potential new tariffs coming, or maybe not. Maybe they get negotiated away. But if we do see prolonged elevation in costs for both firms and consumers, that's a kind of like a negative supply shock for the country. And at the same time, we're seeing evidence of a negative demand shock that is being created by all of the chaos and uncertainty. We're seeing firms delay orders. We're seeing hiring slow down. In fact, labor turnover, hiring that is, and quits and firing are pretty low right now. And that's actually a pro-cyclical indicator that suggests economic activity may be slower than we're currently measuring it.
Well, this raises a question about what we're hearing from anecdotal companies. And I say this both with respect to the Beige Book as well as Procter & Gamble that said it was going to cut 7,000 jobs because of some of the tariffs and other issues that are going to crimp costs. We heard Walmart is going to communicate more directly how much they're going to have to increase some of their costs. That's the inflation side, but also potentially curb employment in certain places for specific reasons. I'm just curious, are those just anecdotal? Are those just good business? Or at some point, do those matter to you from an overall kind of sentiment, Reed?
Yeah, I think those examples are specific to the types of business models these companies have, right? We know that the tariffs are going to be more impactful for companies with thinner margins. Walmart has an awful lot of pricing power from their suppliers, so they can try to buffer it. But even they are saying basically that they can't stop all of this from passing through to their profit margins. I mean, their consumer base is not the wealthiest in the world, and there's only so much they can pay in higher prices. So I think these examples are useful to pay attention to. Obviously, they're not data, and so far, right, the hard data is holding up pretty well. But some of the indicators out of the ISM show us that things are potentially slowing down in a way that we need to keep an eye on. But ultimately, it comes back to earnings. What are these companies going to tell us over the next 6 months?
Right. JoAnne, I hear what you're saying, that the proof is in the profits, so to speak. And if the earnings can hold up, then we might get a different reaction in the capital markets. I'd like to concentrate on the tech sector since it's such a big driver of whether or not we reach this bull market and how long it's maintained. Is the worries that you're seeing on the labor side or on the policy side, does it extend to those frontier firms that are really driving the bull market higher?
Yeah, that's the one area, that's a very bright part of the market and of the U.S. economy and the global economy. I mean, I've written a couple of notes recently about the power of generative artificial intelligence to, keep innovation growing. And that's, I think, the new growth engine for, at least a decade. And so, no, those are real improvements in materials, in products, in services. And it's spreading across the economy. It's creating demand for energy, for utilities, for industrials. So that's real. And they obviously have much bigger profit margins. And also their products in many ways help other companies improve their cost structure. And so in a situation where, economic conditions are becoming more difficult, perhaps we could expect that those AI providers, application providers, are going to see more demand. So that's an area where we think it will continue to grow. We do have significant exposure there for our clients. We'll have Broadcom reporting tonight, and they've been in a center position here. We've held that company for our clients for a very long time. And we do think they're going to provide further evidence that the growth engine continues to hum along.
When it comes to more policy in Washington, D.C., we touched upon what's going on with trade and tariffs, but I'd love to get your thoughts on this idea, which Dan Greenhaus in the last hour just put some cold water on, as well did Speaker Johnson, this idea that it's the House bill that is continuing to, because it's going to increase the deficit, that's continuing this nervousness in the bond market. Do you buy that, or do you think that it's other issues?
Well, the bond market kind of captures everything. But I do believe that the difficulty of shrinking the deficit and therefore the debt longer term is one that every fixed income investor should be paying attention to. I mean, right now, it's debt is pretty high. 100% of GDP. That's not off the charts. We have other developed countries that are higher than us, like Japan. But we can't sustain the continued increase in the debt forever. And as long as interest rates remain high, that becomes more and more costly. So I think there's legitimate concerns about this bill because it doesn't do a lot to improve that situation. And I think what everybody is recognizing, it's awfully hard to get the deficit under control without raising taxes somewhere because we have so much of the government budget that is non-discretionary. And so it really does put legislators between a rock and a hard place, and therefore the bond market says, okay, this is going to continue for a while. It's going to keep longer term interest rates higher for longer.
JoAnne Feeney of Advisors Capital Management, thank you so much for that perspective. And Nela, this is something that people keep talking about, the idea that is one of the aspects behind the bond market. I just wonder if this bond market really is a problem, to Dan Greenhouse's point, is it crimping investment by businesses, or is it something that's totally normal and actually appropriate given the growth levels that we're seeing?
I think bond markets are used as a tool, right? They're supposed to have this special relationship with equities. So the correlation should hold if it's supposed to work in terms of any portfolio. If those correlations are breaking down, it's not just the volatility in the bond market that's a concern. It's the fact that they're not doing their job in managing that risk on the equity side.
And in the meantime, we have, of course, the ECB poised to have a decision in less than 5 minutes' time. President Trump is probably standing by watching to see what they do to understand what the Fed's response function should be in terms of responding to inflation that seems to be coming down.
That's right. He's probably waiting to tweet, as he did yesterday, off the ADP numbers. Nela, I'm sure you saw the ADP numbers, world famous now in the Oval Office. But what's so interesting is Europe is able to lower because of the policies coming out of Washington and what that has meant for the European Union, for the euro, and for the EU's landscape when it comes to the fact that they're dealing with all this trade uncertainty in Washington and people are looking for other places to invest.
Well said. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with JoAnne. JoAnne.
Hi, Lisa. President Trump signed a travel ban targeting a dozen countries, including Afghanistan, Myanmar, and Chad. The measure also partially restricts entry from a host of other nations, including Cuba and Venezuela. It reinstates one of Trump's most controversial policies in his first term. He claims the move was necessary for national security. Meanwhile, in sports, the Edmonton Oilers are up 1-0 in the Stanley Cup final after a thrilling Game 1 victory over the Florida Panthers. The Oilers came back in the third period to force overtime, where Leon Draisaitl scored the game winner in the final minute of that overtime. Game 2 is set for tomorrow night in Edmonton. And Elon Musk is ratcheting up his criticism of President Trump's One Big Beautiful Bill, telling Americans to press their lawmakers to kill the bill. House Speaker Mike Johnson just earlier telling Lisa and Annmarie he's working with the Tesla CEO.
Elon's a good friend. We texted late last night. We're going to talk this morning. He seems pretty dug in right now, and I can't quite understand the motivation behind it. But I would tell you that what we're delivering in this bill is not only historic tax cuts, but historic savings as well. He seems to miss that.
Johnson also saying the tax bill is a step to bring U.S. debt under control. Of course, others disagree. That's your Bloomberg Brief. Lisa?
Thank you so much, JoAnne. Coming up next, Jordan Rochester of Mizuho with an ECB rate decision right around the corner. That's coming up next, and this is Bloomberg Surveillance. We do have a rate cut. Welcome back. The ECB cutting rates as expected by 25 basis points to 2% for the deposit facility rate. This was what was expected. Also seeing 2026 inflation at 1.6%, a prior forecast of 1.9%. This idea of possibly lower inflation, allowing them to cut more than people previously thought. Inflation is currently around the 2% medium target. This, according to the ECB, raising questions yet again. Just one more rate cut? Could they potentially cut more? Right now, Bloomberg's Lizzie Burden joining us with some more details. Lizzie.
Well, of course, the focus isn't necessarily on the cut itself today. That was widely expected by markets, given the euro area inflation has dropped below the 2% target to 1.9%, given you've had the lower energy prices and the rise in the euro against the dollar in the aftermath of Donald Trump's Liberation Day, of course. So the focus really, as you say, on the path ahead and clues as to when they're going to cut again. Is it going to be in July or in September, as economists expect? And if we look at that inflation forecast, as you say, they have downgraded, as expected, the inflation forecast for 2025 to 2% now from 2.3%, for 2026 to 1.6% from 1.9%. And there is, among some on the Governing Council, a concern about the persistent undershooting of inflation. But others, like Christine Lagarde herself, say they need to look through that, given all of the risks in the medium term to the upside upside to inflation, not just from tariffs. If Donald Trump, for example, raises tariffs from 10 to 50% after that July 9th deadline and the EU retaliates, but also from the expansionary fiscal policy as well. Now, in terms of the market reaction, and I know you'll talk to Jordan Rochester about this, because the traditional link between FX and rates has been a bit severed in recent weeks, we weren't expecting a huge amount of euro volatility off the back of this. The focus really, frankly, is more on the non-farm payrolls report tomorrow. So now we look ahead to the press conference. I am sure Christine Lagarde is going to keep her cards very close to her chest when she's inevitably asked if a follow-up cut is coming in July. And I'm sure she'll also be asked about her own future here at the ECB, because there's a lot of speculation that she wants to go and lead the World Economic Forum, and she hasn't denied that she's considering it so far, and it would make sense given that inflation's back below that 2% target.
Lizzie Burden, wonderful reporting. Thank you so much for being with us. Right now in markets, as you're saying, the euro trying to figure out what to do with this, but you are seeing a clear move in German bond markets, yields lower on the heels of what seems to be indicating that there is more room to cut from an ECB that now sees inflation well within that 2% range and downgrading expectations, which you can see across the board is a rally, particularly into the long end. German 30-year bonds now below 3%, 2.95%. What you see in the U.S. is that actually adding to the United States rally that you have seen in bonds. The idea that maybe if the ECB can cut, so too can the United States. Right now, 10-year yields 4.34% in the U.S. Joining us now, Jordan Rochester of Mizuho. Jordan, your first take on this.
Well, it's a dovish outcome in terms of the inflation forecast, the 0.3 revision for the next two years in terms of the numbers for 25 and 26. However, the elephant in the room is what's not in this statement, which is what their view on the impact of trade tariffs. We'll get that at 2:45, that release. That for us will be the scenario analysis. Do they double the impact that they expect from tariffs? What about the 50% from Donald Trump? So a lot of this will have to come out in the press conference. So far, the moves are quite small, though. FX, euro slightly higher. And in the front end of the rates, you've only had a two basis point rally. So nothing too big. We wait to see what Lagarde says later on and those forecasts and those scenarios that come out later this afternoon.
Well, some notice we have when it comes to trade that the ECB statement says trade escalation would lead to lower growth and inflation. Jordan, how do you start thinking about if the European Union doesn't get a deal with the U.S. by July 9th?
Annmarie, I think the EU is probably at the bottom of the list in terms of the major partners. If you think about it, Japan, India, Vietnam, there's much more focus on those negotiations. When it comes to the EU, there's a lot of lobbying to go hard on the EU to reform some of the non-tariff barriers they have, such as the digital services tax with the US and various other sort of non-tariff measures. That's something that's very difficult to agree to by July the 9th. So what might happen is a stopgap, another delay, essentially. That's the best the EU could hope for. We saw that when Trump ramped up the tariff to 50%. We saw an immediate delay, really. It happened within a day or two after one phone call with Ursula von der Leyen. So I expect that the worst case scenario is the tariffs come in at the reciprocal levels, which are around the 20 to 25% level. And the EU will be facing a summer of weaker data as a result and a more dovish ECB. So we're looking for more rate cuts from the ECB than the market's pricing. We like receiving the front end for September, for example. We expect rates to get down to 1.5. This market's pricing around 1.7. Now, if there is a deal done, it's still going to be a 10% minimum. So we're picking between bad and worse scenarios for the ECB.
Is there a scenario, though, where you do think the ECB goes on pause and misses a meeting?
There is, if you see PMIs continuously surprise us, if you have an upside surprise in the PMIs on the next release. The difficult thing about that is the PMI comes the morning of the ECB meeting, so it's going to be really difficult to trade around that event. It could be if you have strong CPI, but if you look at the CPI data, we just had a big downside surprise in services CPI, and the curve, in terms of what the link market is pricing, has inflation below 2% for the rest of the year. So it's really hard to get a hawkish meeting, but Annmarie, I've got to be honest, some of the ECB hawks really have surprised me with their comments suggesting we should have a slower pace. They are the hawks, so hawks have to be hawkish. I think the core unit of the ECB and overall will still vote for a rate cut in July, and not enough surprised. But we need to see how this press conference goes.
Hi, Jordan. understood that there's a lot of attention to the upside risk of inflation coming from tariff policy, but I want to ask a question in the opposite direction. If inflation in the EU continues to undershoot the ECB's 2% target, is there a risk that real interest rates actually turn closer to that zero bound or even negative in the next 2 or 3 years?
I don't think the risk of that is too high, actually, because what we're seeing is inflation is coming down. The ECB's forecasts today have it below 2% for the next 2 years, really. When it comes to the real yield, you've got to think about the nominal side as well. So we're dovish on the ECB in the short term, but actually kind of linking to the question Annmarie mentioned, the German fiscal stimulus will make it difficult for real yields to be materially weak, because what we're going to see in Q4 is the budget is passed in Germany and we'll have much larger amounts of issuance in 2026. The hawks of the ECB might be able to hang on to that, but that is over 6 months away and quite difficult for this market to trade every single day. But for long term, I find it very difficult to see real yields underperforming in Europe because of higher nominal yields I expect to see, with the German 10-year bund getting to 3.3%.
How much of a sea change, a game changer, is German issuance for the ECB?
It's a massive game change. We've had many years where the weak growth in Europe was underpinned by the lack of, or the fiscal austerity we saw in Germany for the past 2 decades, roughly speaking, compared to what others should have done. The Germans have a lot of fiscal firepower, debt to GDP in the 60% level sort of range, and the infrastructure alone, that package, it's 500 billion euros over 10 years. So that's at least 1% to 1.25% of GDP from next year onwards. We don't yet know what the numbers will be on defense. We don't yet know the numbers. We've got a sense of what it will be on tax cuts. We had the 42 billion to 47 billion from the headlines this week for corporation tax cuts. So the numbers will be large. Germany starts from a very strong position, and that's why you're going to see the fiscal firepower matter quite a lot next year.
It's a great question, Jordan, that Nela is raising at a time when potentially the ECB is looking at subpar inflation below that 2% level. How inflationary are some of these fiscal packages that Germany has floated?
Well, it depends on if you're going with tax cuts, that's immediately more inflationary than when it comes to infrastructure spending. So we have to know the sizes of these numbers. So if the tax cuts, we take, let's say it's 50 billion, that's a pretty sizable number for that. Well, that's something that will have to be reflected in their forecast. But it is just a German number. And you've also got the problem with the rest of the Eurozone is you don't have the same fiscal firepower. So the ECB can't get too optimistic from Germany alone. You have France, which is fiscally constrained. You've got Italy and Spain not really able to move the needle on things either. But then when it comes to the infrastructure spending from Germany, that is a big positive that markets like. It improves productivity and expected growth, but it won't translate to high inflation on day one because building bridges and so forth, it'll boost commodity prices and it'll raise the price of building services, but it won't affect everything else in the main.
Jordan Rochester of Mizuho, thank you so much, as always, for the insights. Nela, you raised a really great question, which is this idea of the lower bound. And people said we would never see negative rates again. We've already seen them kind of in Switzerland, but I digress. I am curious about what this says if they see inflation falling below that 2% target as soon as next year.
Right. So remember their past. That 20 years of lackluster growth tied to that zero bound and dipping underneath it. I'm sure it's a past that the ECB doesn't want to return to, and they're looking forward into a different future where the risk of inflations are going up, not down. But I wonder just how material that downside risk is and how it could affect all kinds of things, including the issuance of German bonds.
Yeah, especially if China, say, is going to become a stronger trading partner with Germany, with Europe, and necessarily lower prices to get some of those goods in there. Coming up, we're going to be talking about U.S. economic data breaking trade balances as well as jobless claims. Krishna Memani of Lafayette College here to react, of course, with Nela Richardson as well. Right now, we are seeing bond markets get a bid after that dovish ECB decision. This is Bloomberg. 25 seconds away from initial jobless claims as these crucial indicators give people a final look ahead of non-farm payrolls tomorrow. Equity markets churning as they try to digest economic data that was weaker than expected yesterday, plus an ECB rate cut that's moving bond markets. 10-year yields both in Germany and the U.S. lower on the day. A pretty sharp rally in German 10-year yields, not figuring out what to do with it as the euro versus the dollar. Right now, with the economic data, let's get to Michael McKee, Bloomberg Economics and Policy correspondent. Mike.
Good morning, Lisa. We don't have jobless claims over the wire yet, but we do have the trade balance at $61.6 billion. That is less than half of what we saw last month, 140.5. And of course, that's in part because we see a big drop in imports. We'll get a number on that for you in a second. Initial jobless claims come in at 247,000, so a slight rise from 239 the week before. This is a rise, and it is in a higher area, it sort of goes above the bar that we've been trading under for a while, but it isn't a huge rise. So it does suggest a little bit of additional weakness in the labor market, but not something particularly to worry about. The continuing claims number, 1,904,000, is actually a drop from 1,907 the week before. And then finally, we have updated non-farm productivity, negative 1.5%. That's worse than the negative 0.8%. This, of course, is for the first quarter. And unit labor costs up 6%, up from a 5.7% in the second revision last time. So at this point, we got a little more inflation, a little more weakness in the labor market, and we've got some strength in the growth figures for the second quarter because the trade balance is cut significantly in half.
Michael McKee, thank you so much for that. Right now, we're seeing markets respond to that in the front end of the U.S. yield curve in particular, sharply lower on the heels of that non-farm, of what we saw with initial jobless claims. So lower than expected, but not necessarily something particularly exceptional. Still, it is the highest level going back to October of 2024 with 247,000 initial jobless claims. Nela, what's your take on this?
The take is, to me, that they're still not at a worry point. But the second week in a row of an increase is something to keep a watch on. I don't think people will get really excited until we get well above the levels that we are now. To me, the most interesting part of that, all of that data, was the productivity numbers, because that is the future. And to see that negativity, in fact, productivity is what made U.S. growth exceptional the past year, 2 years. When we talked about U.S. exceptionalism, it was about, in large measure, productivity. So to see those numbers get revised in the wrong direction is actually the biggest concern of everything I heard just now.
Yeah, and it kind of flies in the face of what we heard with respect to artificial intelligence and some of the productivity gains that have come from there. Just before we move on, how much is this tied to immigration and potentially some of the loss of the employment force?
You know, I think you can't, immigration is such a big part of the labor market. I don't know if this slight uptick in the layoffs, are you talking about the productivity numbers?
The productivity numbers.
It's hard to tell at this point. I think there might be quite a few drivers there, but remember that before the pandemic, we were looking at levels like this, and it was really the pandemic that triggered an increase in productivity. So on the other side, are we going back to where we were before the pandemic? That's the question I'd like to ask on that.
Tomorrow becomes really interesting now because we are seeing this tick higher. Neil Dutta just publishing saying we're getting close to some soft employment numbers. And you wonder, are we going to get that tomorrow? And then what would this mean for this Fed? Does this give them this pathway to potentially cut interest rates?
Maybe a pathway. It doesn't seem like they're necessarily going to cut right away. Nela Richardson is sticking with us, and Mike McKee is also going to stand by and parse through there. But in the meantime, joining us now, Krishna Memani of Lafayette College. Krishna, thank you so much for being here. Great to see you. How do you use data like this that isn't bad enough to cause the Fed to make a move, isn't good enough to give you confidence? It just is maybe a trend that we maybe can ignore, maybe need to pay attention to?
Well, so if we ignore it at our peril. That is, I think the economy, as Waller, I think, rightly articulated, the economy is slowing. It's not slowing at a precipitous pace, but it is definitely slowing. And you can see that it used to be in the soft data. Now the soft data improved, but the hard data is softening. So I think there is a substantial trend for slowing in the economy. It's, again, not precipitous, but gives the Fed the path to cut rates, not today, but in the later half of the year.
In your opinion, what would it take to see that cut? What would it take in terms of whether it's jobless claims or continuing claims or the unemployment rate, the mix of it all? How dire does the labor market data have to be to challenge the fact that the economy is fine and can continue to grow?
I think the Fed on that count has kind of been very clear. That is, At the end of the day, what they're focused on for cutting rates is really the employment picture. If the employment picture deteriorates meaningfully, not 1 month, but on a couple of months in sequence, I think that's what gets them there. Again, I think even if we get a soft employment report tomorrow, that is just not enough. However, if we see that in the third quarter and on a consistent basis, I think they have the pathway to cut rates.
Even a data-dependent Fed that keeps saying that they need certainty, and they're very unclear at the moment where trade policy might mean for inflation?
Well, so I think from the Fed's perspective, tariff is really a wild card because they don't know. They don't have enough of an empirical framework to kind of figure that out. And for that, they will wait. On the other hand, if simultaneously, if the markets, if the employment markets are deteriorating quite substantially, I think they have the headroom in terms of where policy rates are today relative to where inflation is for them to be able to cut on a proactive basis as opposed to just on a reactive basis.
Following up on Nela's point, quite substantially, what is that? 4.5% unemployment rate?
So
what's the line in the sand?
I don't think it's the unemployment number itself. It's really the trend in employment growth that on a consistent basis, several months, comes in significantly lower than what the trend rate has been.
Like last year when they cut.
Yeah, exactly.
But it raises a question about how much it would matter, right? How much we're kind of talking about the wrong issue. Is the issue really how much will take the Fed to cut? Or is the issue, are we slowing or are we stalling out? And I think that that's the bigger question maybe for both bond markets and for the Fed. It's not just, do you have to adjust things on the margins? It's longer term, how much heat is left in an economy that has a lot of question marks around it?
Well, so that's a really good observation in the sense that even if the Fed cuts, let's say, in the end of third quarter or early part of fourth quarter this year, the likely impact of that on the markets, at least equity markets, is probably not going to be as positive as people are expecting it to be. Because I think in the throes of a tariff situation, if they are cutting rates, then they are really, really worried. That's bad news that will end up being bad news for the equity market. So that's why I think equity markets at this point, the only upside is really going to come from productivity growth, earnings growth, things like that. And that is not looking very likely at the moment.
Right. I want to follow up on that statement and Lisa's question. And I realize we're asking you to ping pong between the real economy and the markets right now. But what are the growth drivers that you see in the second half of the year that really catapults the economy forward, that raises those productivity numbers? Is there something that we're waiting for to happen that could really trigger that growth?
I don't think there's really anything substantial in the pipeline that can get you there. I think the fiscal impetus that is, or the fiscal impulse that has been in the place because of deficit financing is really what is carrying us through. In that mix, tariffs are basically a contractionary policy. So I think we are trying to balance. There's really no significant stimulus coming into the economy until the tax package passes, and then we see the implications of that in terms of further deficit increase.
Michael McKee is still with us, and he's been parsing through the data. Mike, in addition to a jobless claim, some really interesting trade data as you parse through it. What are you seeing?
Well, basically what we saw, Lisa, was a pull forward in imports. Imports dropped by 16.3%, and that pushed the overall trade deficit down by 55.5%. And the Census Bureau says those are the two largest declines in those categories ever. Now, it's all statistical noise in the sense that we didn't make a big deal out of the rise in the trade balance in January, February, because we knew it was the pull forward of imports. But it does have an effect on the overall data. We'll see a bigger rise in second quarter growth than we saw. We saw the big fall, of course, in first quarter growth. And the one thing to point out about jobless claims is this is the biggest jump, or the highest level, rather, in 8 months. And it's the highest 2 week in a row level in more than a year. So we do see some weakness here. Neil Dutta writing in that that you have about a 260,000 level would be the break even for jobless claims. And if we get above that, we're going to see weak payroll numbers. So we'll see what we get tomorrow. But of course, we're starting to see the numbers come in. Procter & Gamble today saying it's going to lay off 7,000 people. So it's starting to weaken out there.
Mike, before you go, just a quick note. How much are you getting people questioning the integrity of some of this data? As we got reports yesterday from the Bureau of Labor Statistics that they didn't collect data for CPI in certain regions in April due to budget cuts.
Well, CPI is the one that's being affected most and first, but there are also concerns about the labor data as well. What's happening is the government has cut funding and not kept up funding for years, and then we had the DOGE cuts, so they're behind the eight ball. They can't really collect all the data that they have. Now, the data that they do collect is going to be used as well as it possibly can be, but just because you have fewer people collecting it and less data, you're going to have a wider margin of error.
Michael McKee, thank you so much. Krishna, what exactly do you do with this? The idea that the granular data shows some degree of weakening, and yet there's a question about just how accurate it is on any given week.
Well, so it's kind of a sad state of affairs that the best statistical data collecting agency in the world is struggling to kind of do the surveys that we desperately need at this time of transition. But it is what it is. However, I think they do enough data collection for it not to be kind of disturbed in a significant way, and you can probably derive the basic trends out of the data that they're collecting. But I think, again, I would reiterate my point. It's a very sad state of affairs.
But does the data even matter when the policy is changing so quickly?
Well, so data does matter, because how would you expect a policymaker whose one mandate is employment to kind of react to it if they don't have accurate data and a really clear picture of what the impact of the various policies are on the economy? Without that, we are blind, and that would be a terrible state of affairs.
I mean more for the markets, not the real economy, just to put it clear.
So I think to some extent markets do react to policy. And for the policy to be commensurate with the state of the economy, we need that data.
Krishna Memani of Lafayette College. Don't be a stranger. Great to see you. Thank you so much for being here. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. The ECB cut interest rates by 25 basis points, expecting trade uncertainty to weigh on business, investment, and exports in the short term. It's the 8th time in a year that the central bank has lowered rates. ECB President Christine Lagarde is speaking momentarily. We'll bring you those remarks live. Meanwhile, President Trump says Vladimir Putin has warned him that Moscow plans to retaliate against Ukraine following recent drone strikes deep inside Russian territory. Trump and Putin spoke for over an hour on Wednesday as U.S. efforts to broker a peace deal show signs of stalling. The two leaders also discussed Putin's potential role in ongoing U.S. nuclear negotiations with Iran. And the NBA Finals tip off tonight between the Indiana Pacers and the Oklahoma City Thunder. For top-ranked Oklahoma City, it's their first trip to the finals since 2012. They're the heavy favorites over the Indiana Pacers, who returned for the first time in 25 years. Both teams have gone 12-4 so far in the playoffs. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, setting you up for the day ahead. And, of course, ECB President Christine Lagarde's press conference. Don't miss that. This is Bloomberg Surveillance. Stocks turning after an ECB rate cut, the 8th of the cycle. Meanwhile, people looking through some of the trade data as well as initial jobless claims slightly weaker, a bit into the bond markets. 2 years, 10 years, 30s in the U.S. lower, particularly at the long end, with down that 30-year bond down 3 basis points. The euro gaining some steam, interestingly, even after what was perceived as a dovish interest rate cut by the ECB. Still euro strength, 114.37. So glad to say that Nela Richardson is here with us. We are awaiting ECB President Christine Lagarde's news conference. But Nela, before we get started, we were having a conversation with Krishna and yourself about the integrity of some of the data. And I'm curious about how much increasingly markets are trading off other indicators that might be viewed as economic in the way that some of the classic metrics have been.
You know, our U.S. statistical system is the gold standard for data. It continues to be, but I do think there is a broader outlook when it comes to data. We're all in some sense data dependent, but I wish we'd move more to trend dependent, and how companies are actually expressing their outlook is an important data point. Corporate America is the boots on the ground for the real economy, and so their narrative is important as we think about what's ahead.
Nela Richardson, thank you so much for being with us. Right now, we turn our attention to ECB President Christine Lagarde, who is at her news conference.